Good morning, everybody. Welcome to Trade Live with IG for Thursday, the 30th of October. It is me, Chris Beecham, this morning, joined, of course, by the irreplaceable Aaron Bright. Good morning, Aaron.
Morning, Chris. How are you?
I'm very well. How are you?
Very well, thank you.
Yeah, on this slightly brighter morning.
Yeah, a bit chilly today.
Yeah, a bit chilly, but you can feel the autumn chill in the air.
Overcoat's back out. Very in hibernation now. It's out for the first time this year.
Yeah, let's look at the view outside, shall we? See what it's like in London. I think it's a traditional thing to do now. There we are. Look at it. It's not too bad. Dry.
Much brighter than usual. 4
degrees in the air. The 4 degrees this morning on my way to work this morning, so you can feel it beginning to come.
Yes.
It's been a busy 12 hours already, and it's set to stay busy, of course.
Definitely.
So you've had the Fed last night, earnings from a few minor tech companies last night.
Yeah, and then we're coming into the sort of big earnings soon.
More earnings tonight, and of course comments from Donald Trump hitting the wires as well over his trade deal with China, which we'll come to in a minute. Should we go through what's coming up first?
Absolutely.
You want to take
right, so right now you've got overnight action with myself, Aaron Bright and Chris Beecham. Opening bell with the two of us again. 8:10, guess the chart. 8:15, man versus machine with myself and Martin Harris. And
is he out of bed? That's the key.
And we've got a special feature in today's edition, so you don't want to miss that. And 8:35, we've got a recording of The Art of Investing with Rich, Mark, and Chris.
Episode 16, Art of Investing. Gosh. There you go. So what's the special? No, you can't tell me what the surprise is.
I can't do that. There's IG snipers everywhere. You know.
Oh, I see.
You out.
It's like the Oval Office round.
Exactly.
Good morning, everyone in the chat. Good morning, Gavin, London, Jugger, Away from the Numbers, Wing It, Idarog, Carlo. I heard people talk about the gold in the sauna yesterday. Says that talking about gold in church. I don't know, but I'll leave that one. But yeah, I'm sure we'll come to gold in a minute. Funky Given, good morning. Andrew McKelvey, good morning. Shell numbers, yes. Q3 numbers from Shell as usual, and an unintelligible bunch of numbers you get from Shell because they make it as boring as possible. These RNSs.
Yeah, I've been a pleasant shareholder of Shell. I shouldn't say that too quickly. It's a bit of a mouthful, but yeah, the stock's done very well since the COVID era when I started loading up on it when. You know, the oil prices went negative with the future derivatives. Well, the derivatives going negative temporarily.
Yeah, exactly. Yeah. Fun times. Let's go to overnight action, shall we? See what's been going on. So we had last night, of course, Jerome Powell and the Fed.
Yes. The man who has the ability to move markets like no one else. But
if only for 5 minutes.
Yes, yeah. I think maybe Elon Musk has got a slightly more power with that. But
so we had the 25 basis rate cuts, as expected.
Yeah.
And from the statement, it was quite dovish. I thought the statement itself said we're focusing more on the labour market. Quite what labour market data they're focusing on, I don't know, because obviously we haven't got any.
Well, with when he was looking at other things before with inflation, he was looking at very weird areas of the yield curve. I remember in 2022, so he does have weird metrics what he looks at when he measures certain things. But you know, I think the concern for equity markets and why you got. I mean, I saw people on X complaining last night that there was a sell-off. I mean, there was nothing. It was.
Yeah.
I think when you're so used to 1% a day for what seems like eternity.
Yeah, the modest drop suddenly becomes a bit of a shock.
Absolutely. So. I think, look, and I've been looking very closely at the yield curve, and it's pricing in cuts. And I think if there's concerns about cuts not coming to fruition, that's when you get the volatility.
Yeah.
Because people are pricing that into what companies are able to do in the index.
Exactly. And there was your drop on the hourly chart for the 6 o'clock in the hour, and then come back again. A little bit of volatility around the 8 o'clock mark as well, because, of course, you have plenty of earnings. But the key thing from Powell was a chart off. Thank you. They said, yes, we're cutting in October, and it's fairly dovish. But then the line about December is very, what was the phrase he used? In a very strongly...
Well, he just, the exact wording I don't know, but he was just shedding like some doubt on whether it would...
That was it. The chances of a December move have suddenly dropped back.
Yeah.
Let me see if I can find out what he said, because I know what it was there, but he was very much kind of saying stuff they didn't actually need to say to really sort of reinforce the point that a December cut is not guaranteed.
Yeah.
Far from it. That was it. Far from it.
Far from a guarantee.
And that's the kind of, having said in the Jackson Hole in August, there'll be a rate cut.
And he also said that Jerome Powell thinks rates don't have far to fall, which is, I mean, I always tell this story, so apologies if you've heard me say it, but I remember looking at the markets end of 2022 and seeing that rate cuts were priced in for pretty much all of 2023 and 2024, and we didn't actually get one until late 2024. So we know that investors like to be exuberant when it comes to rate cuts, and
exactly. Everyone loves a rate cut.
Exactly,
Well, stock investors do,
and can overestimate the ability of central banks to cut rates in quick succession.
Yeah.
So whenever there's a change in that rhetoric, or you actually get a figure from a central bank, or the biggest central bank in the world, most powerful one in the world, say we might not be cutting as quickly as you think. That's why we saw a little bit of a pullback in the US equities. But it didn't. I mean, given the sort of message he was giving out, one would expect markets to typically take that much worse than they did, arguably.
Yeah, I think so. And the chances of a rate cut for December now dropping back down. I think they went down to 63%.
Yeah.
In the wake of the statement, they've nudged back up again to 70%. So they're still leading. And I think it makes sense from Powell. You don't want to sort of, you've had 2 months where we knew rate cuts were coming.
Yes.
And you can't let markets just get away with it forever.
And you saw a tepid reaction when the rate cuts came.
Yeah, and you shouldn't allow them to assume too much, I think. And it's Powell simply saying, you can't take this for granted.
Yeah.
You don't want to just write the Fed off for the next 3 months.
No, and that's when you get into bubble territories, when you sort of, I guess, issuing positive guidance when it shouldn't be issued, I guess.
Yeah, I think this is the key thing. So it was Powell really just sort of saying, don't get too carried away. I think we'll still get one. And I think it was Nomura, though, has changed its call from a 25 basis point
to a hold.
To a hold. So somebody is folded on this front, which is probably what they want. Because then, look at it this way, maybe this is me being too bullish again, that you get a rate cut that is not as expected, and therefore you get more of a boost. Not that the idea of a rate cut is to boost the stock market.
It's like a double bluff in a way, where it's like we're not cutting rates, but we are going to cut rates, and even though we were going to anyway, but we were not sure about saying that we were going to guarantee it.
Yeah, exactly. I mean, this is a good one for a poll gallery, I think. Should we have are they going to cut in December? Yes or no? That's always a good one to start with. We should talk about...
I don't know how I stand on that.
We don't know. Well, you've got to have an opinion. There's no sitting on the fence.
I think it's likely, but I think the inflation figures are going to determine it. I think that's going to be massive, and also the labour market. And I think the next prints that come out with regards to that are going to be really important.
Yeah, there's a lot to play for. I think it was just Powell sending a message, this isn't really baked in, everybody. We can't assume this is going to happen. So we talked about... So that's the Fed. What else happened last night?
Well, the ECB today.
We'll do the ECB in a second.
Okay. So I'm getting ahead of myself.
I don't care about the ECB. Let's talk about important things.
Well, GSK was...
You're just deliberately winding me up now, aren't you? Let's do the tech stocks. I haven't got time for minor pharmaceutical companies and small sector banks.
Biggest companies in the UK.
Nvidia, which passed the $5 trillion mark last night. We'll come to that in a second. But yeah, the Mag 7 reporting last night. 2 of them beat expectations, not so much, I think it was Meta, wasn't it? Meta was the shocker last night. But they, again, Sundar Pichai doing a slightly unfortunate hand gesture there, some people might say. But there we go. You probably didn't think that one through, but let's not talk about that. But very solid numbers from both of these, from Alphabet and Microsoft. This is the key thing, of course. Is AI cannibalizing Google's search revenue? Is AI beginning to hurt Microsoft?
It's interesting, Goldman Sachs have actually, their equity strategy team and global investment research team have issued a note over the past week or so saying that when you look at these markets or you look at AI, it's actually not in bubble territory compared to .com because they're delivering the earnings, and that's the big difference. You're seeing the potential PE and Cape-Shiller ratios in rather bubble-like territory, but if the earnings can come to fruition, you're actually paying a price which is technically suitable.
Yes. Now, I didn't see the full note. I read the FT Alphaville post on this, and I read the blog that Goldman's did, so I haven't seen the full Goldman's note. So, if you know people who have it, then do send it over. That's an in-joke there. But it was interesting that they come out and said this, because the number of, and I think I might have said this on Monday, so apologies for repeating, Tuesday, but apologies for repeating myself. The number of questions I've had about, is this a bubble? What people do to protect themselves from if a market falls, all this kind of thing.
I was discussing this in the pub last night, actually, with people in the industry. And I think there's divided opinions. I think, as I said, the main positive is the earnings. But if you get a change in earnings or a slight change in guidance or a change in trade policy, which I'm sure we'll come on to, the whole because the valuations are stretched.
Yeah, and this is, you
Sure,
can't, no one would dispute that, I think. They are priced very...
You can look at any historical average chart and it will be high, right?
Yes, exactly. And they're priced for sort of not, I don't like the phrase price for perfection, but priced to do very, very well. And the risk is, as you see with Meta last night, if they don't do well, the shares do get punished. And this has been an earnings season where you do get punished for this kind of thing.
Yeah.
I think so. This is the problem we're dealing with, really, that you just can't miss these expectations. If you do, the market is not going to be very tolerant.
No, not at all. They'll just find their next winner.
Yeah,
I think so.
And they move on. But as you said, we haven't had this massive reaction to Powell sounding cool last night, and you had Meta missing forecasts, but the other two being okay, and the market reaction was generally a bit of, don't care.
Do you think that's down to just general greed at the moment in the market? Because if I quite like the CNN Fear and Greed Index, and it's showing at the moment.
Where are we now?
Well, it's actually showing a bit of fear at the moment, but I think that's probably as a result of maybe sort of moves we had last night.
Get this one up.
But obviously, we've seen a fair amount of greed, I guess, with regards to that previously.
Yeah. So if you get the chart up on this one, it's fear and greed. So it's a kind of gauge of market sentiment. I'm sure a lot of people know how this is calculated. And I think the way it's calculated is probably based on a lot of momentum on anything else. But it was notable how we went to. I think we went to extreme fear last week, didn't we, or a couple of weeks ago, which I think sort of speaks to how jittery people still are. Really, I think that's the bottom.
It's very up and down. People's and it's. I think it resonates well with the discussion that we've had today. Is 1 minute we're saying that the earnings were strong, but the other minute we're saying valuations are stretched, and I think that's why we're getting this sort of swing where 1 minute people are a bit greedy, 1 minute people are concerned. I'm getting jokes about Chelsea.
That was a football joke. That completely passed me by. But I thought,
I'm getting abused about Chelsea's form by Phil. So
John was for goalposts, that kind of thing. But there we go. There was a drop into extreme fear, amazingly, for a market that was 2 or 3% off record.
Yeah, because you usually will get the extreme fear when there's a Ukraine war, for example, or a ridiculously high
or as you can
inflation
see there, that April was your extreme fear.
That was
proper fear. You went further back.
That was, are we going to have 6% inflation as the norm because of tariffs?
Yeah.
So completely understandable.
But if you go to macromicro.com, there's a really good one where they've charted it against the S&P and it goes back in time. So you can see, everyone loves this kind of busy chart. Is that on full screen?
It's like a chart you get in one of those pitch decks where there's so much going on.
Yeah, exactly.
Yeah.
Oh, I can't do it right. But you can see that there. This is how this coincides with periods of substantial market tension, and suddenly you had this. We were right back down again with a market that was knocking on the door of 7,000. I think it's really impressive. But we should talk about overnight. Of course, you've also had Trump and Xi, the long-awaited meeting of the two titans of.
Who Trump says he has a fantastic relationship with.
Yes, and this typical Trump, we should have got this clipped in for the video this morning, but they asked him how it went, and he said on a scale of 1 to 10, it was 12.
Oh.
This is
sweet.
All over. I think I was saying something this week, I think everybody sort of learns when they grow up that if you're going to tell a lie, don't tell a massive lie. He never learnt this. So everything he does has to be the best thing ever. He is the only president to ever win a war. All his meetings are brilliant. All the people in his cabinet, they're the best cabinet ever, including the Roosevelt's cabinet that won the Second World War. This kind of thing.
Yeah, he's certainly got a way about him.
As I said, something else, it's all turned up to 11. In fact, it's turned up to 12, clearly, with this meeting. But I think New York Times had a really good opinion piece overnight that said US has essentially given in because you got soybean purchasing commenced or recommenced, and China said it wouldn't curb rare earth exports for a year.
And then BBC have come out saying Trump lowers Chinese tariffs and announces the end to the rare earth roadblock.
Yeah, exactly.
Can't get my words out today.
And this looks like he's sort of folded, really.
Yeah. I think he's, I think back in April time, we saw Trump push the tariffs because he was concerned, I think, in my opinion, and I think to a lot of geopolitical strategists, he was concerned about Chinese hegemony with regards to tech and trade, and he wanted to preserve America's status as, the strongest economy. Obviously, I think he's realised now that you can do that to an extent, but consumers want low inflation and wages and employment, and that potentially can jeopardize that if you have the cost of goods and the cost of services rising as a result of tariffs. So I think that's why he's making these concessions, because he has to, I think, deal with China. And as Funky Gibbon has said,
taco strikes again. Exactly. It is this, because I think they moved too quickly on rare earths and they thought that China would fold, and they haven't. So now they have to find a way of maintaining those rare earth imports without and developing their own.
Absolutely.
Which will take years.
Yeah.
So you essentially have 5 to 10 years where you do have to just make nice to China.
Yeah, absolutely. And those rare earths, as I was just about to say, are just so important to everything. I mean, there's probably plenty in this room in some way, shape or form which have been used and broken down and put into our devices. So, and you know, that's the way of the world, is through tech, through cloud, through any other technological buzzword.
So this is how the markets stand this morning. So you've got the Dow, US futures. My Dow chart doesn't work for some reason. Why would it need to? There's S&P 500 just sitting there just below 6,900, having come obviously just slightly off the highs. In fact, record high overnight, so that it's still very, very resilient after those numbers. The one that has taken a nasty bit of a hit has been the Hang Seng. So clearly that was expecting a bit more in terms of a deal from China.
Yeah, interesting though. I probably wouldn't have expected it to be as, you know, in the short term, as beaten up as that, but
no,
nothing too crazy.
No, it seems surprising it was taking it quite so badly.
It has done fairly well, as has emerging market equities in general this year. I think they've been the surprise package.
Yeah. They have really.
Yeah.
I mean,
I think because since April, there's been this sort of cooling of trade tensions. I mean, there's always a bit of back and forth, but the relative cooling, and it's always about what's happening with expectations. And as we saw in April, it was that extreme fear. How bad is this going to be? Are we going to get 5, 6, 7% annualized inflation forever? Or not forever, but for a sustained period of time because of the tariffs. But now, as soon as that went out the window, then, you know, the tariff reprieves were coming non-stop. Then you saw equities in general power on.
Yeah.
Almost said Powell on.
Yeah, Powell on. Freudian slip then, so who knows. But you've got the S&P sitting such a long way away from its sort of 50-day moving average. So the risk, I think, is still 2 months to go for the end of the year. Not necessarily a massive pullback, but maybe if there's just a kind of, I don't know, disappointment or just boredom.
I'm going to use the term you don't like, the price to perfection, a little bit.
Yeah.
I think if there is a change in sentiment, that's at this sort of level and this sort of valuations, you could get some substantial moves.
Yeah.
But and I think policymakers and investors do know that and are planning accordingly.
Yeah. But you've got more gains in the Nikkei. Another record high. How many record highs? Is it a record high every day this week?
Yeah, it's weird as an investor, you know, who's been doing this for a few years to see that, like, how well Japan has been doing.
Yeah, they've still beaten by tech over the last 6 months, but they are the best performers.
Yeah, it's incredible, really.
Since the low.
And also how well the FTSE's done. I mean, it's still outperforming the S&P yesterday.
Yeah. So futures looking fairly solid. Even the DAX, which, as I was saying, has been refusing to cooperate with my trade of the week from last week to go long. It's just sort of ambling along.
I think every company in Germany knows that's your trade of the week. And that's
I think so. There's poor performance and more bad numbers from Porsche. And it's not an excuse, it's a reason. There's a difference. Thank you, Gallery. Reason, rationale.
We're getting a lot of abuse today.
I am. Well, apparently
I
can't talk about football, so I think it's spiky for Thursday morning. And, you know, clearly had their Weetabix, which is a joke that dates us all a bit, I think, if you won't remember that joke. Anyway, so there's Germany looking a little bit stronger, trying to rally once again. France as well, budget turmoil apparently looming in France again. What else is new?
France has been a bit of an enigma this year. It's not been quite as strong. But yeah, I mean, I think they've got so many political problems. I mean, it seems like every day that Francois Hollande, Macron has issues.
Long gone.
Yeah, long gone. Issues with the political system there, with the prime minister, with you know, really the ability to sustain confidence in the parliament and the political system there. So there is just so much going on.
New election looming at some point. But the dollar as well, looking this morning, much stronger than it was. So there's comments from Powell really giving you a bit of a boost. So that's,
I think so. Yeah, when, you know, rates are going to stay, if they are going to stay up, then it helps the dollar. But I'm hoping still. I've got about 7 weeks for the dollar to go to the pound, because I'm going to the States, so I need it to weaken selfishly.
Lucky. You're really lucky. I don't think that's going to happen.
No.
Good.
No.
Well, we'll run through the RNSs in a minute. I think we'll take a break there, and then we'll come back to you in a couple of minutes.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission-free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves. Welcome to the Art of Investing, a brand new podcast to help you achieve your investing goals. Join me, Rich McDonald, and my co-hosts, Mark Spice Holden and Chris CJ Fellingham, every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience. If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
And welcome back to Opening Bell. Now the poll is still running. Are the Fed going to cut rates in December? About 47% say no. 30% of you have no spine and have said they're not sure. I think we need to ban that option. Personally, I've always thought you shouldn't give people an option to sit on their hands because there's.
Well, last week you said it was like with me trying to nail jelly on a wall.
Yeah, exactly. I'm sorry, that was quite rude.
No, I thought it was funny.
Like being a proper fund manager, never gives a proper opinion. There we go.
I've been trained.
We should talk about rate cuts also in the air at the Bank of England, apparently, according to Goldman's, if you get my screen up. This Times story, and this is a bit of pound weakness coming through the last couple of days, really. Sorry about that for your holiday, Aaron, but there you go. Bank of England poised to cut interest rates for the 6th time in just over a year due to rising unemployment, weaker, and inflation, and obviously the worry about tax rises will hit economic growth.
Yeah, well, it's a tug of war because we've got rising or sticky inflation, but then a very weak labour market. So it's, do we cut rates when inflation's stickier than?
Yeah, but it's weaker than it was. This is the key, isn't it? From last week's inflation data was suddenly...
Is it weak enough?
It was such a step change because everyone expected it to just get worse and worse. And obviously ours is much higher than the rest of the G7.
Yeah, and the highest 30-year yields, the highest inflation.
Yeah, but it wasn't as bad as expected. I suppose this is the key thing with markets, isn't it? We're not talking about what happens now. We're talking, do we think this is the beginning of something?
Yeah.
6 months down the line, inflation has weakened. So yeah, we're expecting the UK to keep coming down, although we're still well above the Eurozone and just roughly in line with the US. Sorry, gallery, to make you up and down.
Yeah, I wouldn't be surprised if they hold.
See that there.
But I could see it. It will be a close call, I think, either way. I mean,
Nomura agrees with Goldman's as well, says that it's time, the pressure is sort of building to loosen policy. And you can take the screen off now, thank you. Because the comments that, again, in the news this morning, it looks like Rachel Reeves, who seems to have dropped herself in hot water last night over her house in Dulwich.
Yes, and then Starmer's issued a statement this morning saying, it's fine. Yeah.
Anyway, enough of that. But yes, this looks to be probably going for this actually 1p in a pound rise in income tax.
Yes.
Which is quite the... controversial.
Well, I was having a chat with our tax team yesterday about the potential ramifications of the budget, and yeah, I mean it's still very much a guessing game, but I mean the writing is on the wall in terms of the fact that Rachel Reeves has been very transparent that she wants to raise more revenue,
which is a massive manifesto breach. But then I suppose that the logic is that if you do it now and it gives you more room to spend, people will have forgotten in 3 years' time, 3.5 years' time.
Yeah, it's not like we've got an election in 6 months and we're going to make income tax 25% at the basic rate or something crazy like that, which would alienate all voters.
Yes, just to give people more room to manoeuvre. So the Goldmans and Nomura are expecting Bank of England to join in the fun of cutting rates. Don't forget the poll is still going whether you think the Fed will cut rates in December. I'm probably still on the idea that they will, because last night was, as you say, a bit of a bluff.
Yeah.
To just remind people you shouldn't take anything for granted.
We've got an interesting comment from Andrew McKelvey. Bailey should be sacked. Has never hit his 2% CPI target, and RPI is around 1% higher every month.
Maybe.
Yeah, I mean, he's come under a lot of criticism, for sure.
Yeah.
I think.
Very much a difficult...
My I think, concern, and I think many investors' concern around Bailey, well, the Bank of England in general, was just how sluggish they were in terms of responding to inflation towards the end of 2021. The US were slightly similar, but I think with us, we were really late to start raising rates.
Yeah.
And then if you contrast it with the likes of Brazil, and I believe Mexico, when inflation was creeping up during that time period. Yeah, they were. I mean, I was in Mexico at that point. That's the only reason.
Oh, I see. Okay, local knowledge, right?
And that they were beginning to raise rates much quicker and much earlier than developed market counterparts, which is unusual for an emerging market. So, I think it was disappointing to an extent, and I think potentially. But look, it's always easy to look at it with hindsight and say that the rates should have been raised earlier, or policy was slightly too loose. But yeah, I think Bailey certainly has come under a lot of pressure.
Yeah.
Can't say I know him personally. So.
No, but then I suppose it's the Napoleon's line about, I don't care if he's good, is he lucky? Mark Carney was lucky in his situation.
For sure.
Not to defend him too much, because I'm probably not in a company of Bailey fans, but he has probably been unlucky in his situation.
he took the job in March 2020. I remember seeing it on, I think, one of the news channels, and I was thinking, wow, this guy's has taken a job at a historically awful time, a pandemic. How do you respond to that? You've got furloughs, unemployment, and an economy in hibernation.
Yeah, exactly. And we should do, in the 1 minute before the bell or so, let's do Shell. Big numbers this morning from obviously the oil titan in the UK.
Yes. I should probably declare I'm a shareholder. So
that's right. We need a thing across the screen.
Yeah.
Like they do in CNBC.
Yeah. No, really strong numbers from Shell. I think looking to expand their areas of business, and we've seen the likes of Trump, push towards more fossil fuels relative to the Democrat counterparts in America.
Yeah.
I think once you've got someone in office who's bullish towards fossil fuels, Shell are going to be a natural beneficiary relative, in my opinion, to BP, because BP were much more on that sort of ESG green energy trend, spending more on it than Shell over the past sort of 5 to 10 years, I would say. Yeah. And let's see how the shares are doing. Oh, it was a good day yesterday for them. Yes, absolutely storming day for Shell. Yeah.
And obviously, it's slight improvement in oil prices.
It was pleasant when I
Very strong
opened up
recovery.
the
Let's just see where we're on
portfolio.
the fundamentals since you've got a fund manager in the room. 11 times earnings and dividend of 3.7%. So
Yeah.
it's not shabby, is it?
It's not, and it's not expensive. An 11. You know,
No.
So
No, so not a bad performance. Have you got your bell ready, Mr.
I
Bryant?
do. I've got a choice of bells. I'm going to use the LSE one because
You get the slightly tinkly one. And
Yeah.
of course, you've got all sessions coming up in a second. Ready? More to go.
still got 1 second.
There you go.
Market is open.
Someone, I always expect Phil to appear from the gallery with tea when you do that. That's the
Yeah.
That's the thing I need to do. Maybe, yeah, not today, maybe. Good, let's see what we've got. Let's go to the FTSE 100. If you can see that there. Oh, you want me to zoom in? Of course, of course. There you go.
So Standard Chartered.
Standard Chartered also numbers this morning, so up
Yeah.
2%. So following on for its cousin HSBC.
And Shell is up just over 0.5%, keeps fluctuating a little bit. IAG, I mean, also up 0.75%, and that's had a stonking year.
Yep.
Really, really strong year. Still on that post-COVID travel boom. Lloyd's is up around 0.5%.
Yeah, doing the propping up the banks, I suppose, from NatWest.
And EasyJet also around 0.6% up.
Airlines lifting nicely by that news. There we go. Not taking off, but gently ascending. So there we go. Let's see if we've got
losing?
on the downside. Oh, look at that surprise.
Yes, I also own Diageo. And
Do you? I think I used to.
And
but I
that's
don't anymore.
been a nightmare. So down 3% on the
So
day.
you can drink your way through it, I suppose.
Yes, I mean this coffee is non-alcoholic, but maybe I'll
Do
have
your best
to get
to prop up the
something
shake.
stronger.
Yes, go and get something.
Anglo-American down to 2%.
Oh, no, I'm shareholder Anglo-American. That's not good.
I think whenever I'm on this show, Antofagasta is down, so I apologise if anyone's an Antofagasta shareholder and they see me here.
Commodities in a second.
But that's down 1.75% today. AstraZeneca down also. I wonder if that's down to the fact that GSK was up so strongly. Maybe.
Yeah, and HSBC are down a bit this morning. Probably they had a stonking day. Second used the word stonking by us in the last 2 minutes. I do apologise. We'll come to that in a second. The keeping score in the gallery. Glencore as well off. Fresnillo 1%. Let's look at the commodities because that's probably the key thing moving. Gold edging its way higher.
Still below that golden
Still
4,000 figure.
4,000,
That was
yes.
non-intended pun, by
Big
the way.
round numbers still dropping. But had a good day yesterday until Powell knocked it back, unsurprisingly. Silver up a little bit. Oil prices, I'm so pleased to see oil down this week. My trade of the week being short oil. So I'm gratified by this 1% drop.
That's, I mean, how do you see that one going? Because we've obviously seen a peace deal in the Middle East, but it's a very fragile paper piece, I would say.
Yeah.
I mean,
But one thing we've learned over the past year is that oil doesn't care about Middle East actions. But Iran, Israel briefly, and then back down again. So,
but the thing is, the conflict could span greater. I mean, the concern is that if the Straits of Hormuz close, I mean, there's no potential of that at this juncture. But if that happens, then
I don't think the Iranians have got any ability left to do that, have they, this morning? Porsche, they had numbers. Was it numbers this morning from Porsche? They disappointed, but clearly the share price doesn't care. So a decent rebound from
yeah,
them.
it looks good.
WPP, yes, profit warning for WPP, I think it was. And the CEO said she was, you can take that chart off. I think it's like disappointed with performance. So not angry, just disappointed, which is just
Sounds like a parent.
Yeah, it's sort of that kind of, I'm just sad that we're not doing very well, which I'm sure the shareholders found very gratifying from WPP. Good, let's go with if I got my all sessions list up. Almost certainly almost on there. Yeah, look good. So what we've got in early trading this morning, there we go, that'll do. Let's do it by United States and indices. And F11, we're very demanding in the gallery this morning. There you go. What have we got moving? Nvidia up slightly. Meta, of course.
Yeah, really
Dog of the
struggling.
day.
7%.
Yeah. But again, was there a record high was back in, what was that, August? So
If I'm not mistaken, I think they had a day in something like 2022 where they were down something like 15% on the day. Oh, Phil was telling me he confirmed
must have been his fault, really. Must have forgot to turn on the.
Yeah.
But Alphabet more than compensating with the 7% rise. Microsoft down 3%. And of course, the other news from yesterday that we should probably talk about briefly before we go for a break. OpenAI is to IPO in 2027.
Interesting.
Apparently. This is the new plan.
That's going to certainly attract a lot of interest for sure. Yeah, really interesting to see how that one goes.
Get the news article up. So I think that could be the most hotly anticipated IPO since what? Facebook, maybe?
Yeah.
$1 trillion.
Shame it won't come to the FTSE, to the LSE.
Could you imagine if it listed on?
Yeah, imagine Sam Altman saying, right, let's list this on the LSE. So.
It would not be a surprise. There we go. So you can see that open. Today's groundwork for a
Brilliant, wow.
juggernaut IPO. I like that from Reuters. Very good line.
Very nice.
Reuters,
Yeah.
Explaining it's well, I think really I have got a Reuters account gallery. It's on my I'm logged in on my actual platform if I can find it. But it's potential news, big news there, really, isn't it? So,
$1 trillion IPO. Would that be the biggest ever?
There's a good stat there. Someone in the gallery might know. Someone in the chat might know.
So I remember the big one that we've seen probably over the past, well, it's probably more than a decade now. Meta or Facebook. Facebook was a big one back in 2013, 2014. That was a huge one.
Yes, I was here for the first day of trading in Facebook, and of course it didn't go for about an hour or so. There was a glitch in the system and everything was completely bonkers. I've got WPP there this morning down 7.5%, so gapping lower. Is that a record low, an all-time low? No, obviously not, but it's here's your technical analysis coming into play. There's coming right back to these levels not seen since the heady days of 2008. And of course, if you'd bought WPP then, you'd had a fantastic run for all of 10 years and then up straight down again.
Looks scarily similar to the Diageo pattern, actually.
The pattern of death, yes.
Yeah.
So there we go. A nasty set of numbers from WPP this morning, if I can find them for you. So very much the poor performer on the FTSE 100 this morning. What else have we got? We'll just end the poll there, I think. We'll just see what we've got in terms of results.
Got an interesting comment as well. Saudi oil was the biggest IPO. Aramco.
Aramco, yes, yeah. That's true. Yeah, I think so. So
thank you very much, Jesse14.
Yeah, thank you. So yes, most 43% say no, they won't cut rates in December. This is the Fed we're talking about. On the time fence, I'm trying to work out what that means. I mean, it just means on the fence, doesn't it? In time, right? Okay. And 25% says yes. So 57 of you brave enough to vote in that one. Thank you very much.
I think I could vote for all three here.
See, there's my jelly comment again. All three of them, whichever. I have many opinions. Which one would you like? That kind of thing. Definitely. Good. So just go back to the moves this morning. Halion creeping back to the top of the index at 3.7%. Let's see what we can do. I see. There you go. Can't do these things. I can't multitask. There we go. 2.3%. Standard Chartered still leading the way up 2.9%. Need to call it 3%. Airtel Africa, there were good numbers yesterday or the day before, wasn't it?
Yes, we've definitely seen some activity there.
Yeah.
So no, looks good so far.
Beasley creeping up there, interestingly enough, as well, and BT Group as well. So not a bad performance. WPP edging with 9% losses now.
Do you think they could get out of the FTSE? They could be relegated.
They must be on the
knocking on the door.
Drain.
Yeah.
Really, they must be the next ones to go. I wonder how long they've been in it. Diageo down 3%. Coca-Cola European down 1.5%. HSBC. GSK taking a bit off from was it yesterday, the numbers?
Yes, it was. I think they were up 5% yesterday.
Okay, good solid numbers. So a slightly mixed morning, the post-Powell hangover for indices more generally. Let's see what we've got in terms of our movement. Let's see what we've got moving in terms of Germany, still clinging on a little bit, FTSE 100 easing back again. And let's do FX markets as well.
Yes.
Pound
is down slightly. So yeah, cable's a little bit weaker. A little bit of strength in dollar yen and euro dollar as well.
Yeah, dollar yen, the interesting one, because that's obviously taking mixed performance over the past couple of days, but once again on the way up. So
do you think that's as a result of the Powell hawkishness?
Yeah, that will be Powell's comments, I think, really, but also the underlying tone of the new Japanese government, really. So the carry trade is back, it appears, which is going to be great for the Nikkei. So that's one, I think, even at nearly 52,000 on the index. And it's really interesting, of course, because you can take the screen off.
So you're saying that's the reverse of the carry trade is bullish for equities in Japan?
Yeah, in Japan it weakens the yen. But we obviously, in 1989, where the Imperial Palace in Tokyo is worth more than all of California. And now Nvidia at 5 trillion is bigger than the Japanese weighting in the All Country World Index. So history has a mirror way of sort of working itself out.
Yeah, that sounds like an advert for capitalism, really.
That does really is that sort of the peak of madness for euphoria for tech stocks? We'll see, but certainly the parallels.
Well, if they can keep their earnings going, I guess the music continues.
Well, it's the thing, because I remember we had the first $1 trillion company, and then obviously Microsoft and Google and
yes, I remember
passing
that.
3 and 4, and Microsoft joining 4 this week, and then you've got Nvidia at 5.
And I just find it interesting when you look at the American equity valuations and you compare that with the FTSE ones. Like you've got US small caps who are like the same size as some of our big companies.
Yes, a small cap in
In
the
terms
US
of
is a lot
market
bigger
cap,
than a small cap FTSE 100 of the same size.
Yeah.
Really. Yes, that's unfortunately how these things work, really, given that US markets are, what, 70%
Yeah.
of the total.
Yeah, I remember when they were a lot less than that, or they were 60.
But as Reuters was saying yesterday, Jamie McGee with column Reuters was saying how if actually the US isn't the most concentrated market in the world. There's things like Taiwan and Canada are much more concentrated.
Oh, in terms of the indices constituents?
Yeah.
Yeah.
So TSMC is obviously
yeah.
a massive weighting in the Taiwan index.
Canada will probably be Shopify, will be a big one.
Maybe, I don't know, but it was US was only sort of 5th most concentrated.
But it's just so heavily invested globally. That's, I guess, the
Well,
concern.
where else will you go, really, I think is the most important thing to bear in mind.
Now,
Good.
the FTSE this year.
Yeah, well, it's done well. And of course, at only 40 times earnings, it is still cheap relative. So I think that's where, if you want your refuge from bubble fears, not that there is a bubble, I don't think, but
Yeah.
there is one of your places that seems to be benefiting.
Well, long-term investing, we like to, diversify the portfolios. We like to look at different regions. We have US exposure in our portfolios. We have UK, we have Europe, we have also emerging market in Japan, which has done quite well for us. But our concern's always been around how much can the US sustain this. But we've got positions that if this continues, we'll be okay. But we've got other equity positions in the portfolio to steady the ship.
Well, that's good. And we'll find out in Man versus Machine, won't we?
Yes, certainly.
You're still not telling me what the surprise is.
I can't do that, I'm afraid.
Don't forget to like and subscribe. And I think, can we go to guess the chart now? Are we allowed to go? There we go. So it is a US stock. So that narrows it down for you. And thank you very much. And we'll see you again in a minute.
Well, the FTSE's dancing in the morning light. Shots on the screen and the game's in sight. Axel's got a trade, says it's looking hot, but Rich is clicking faster than a scatter shot. Haynes lanes in, says, hold on, boys. I've got questions, don't make no noise. Producer Phil says, here's the next slice, and please remember, not financial advice. Guess the chart, let the fiddle cry. Is it shell or rose? Will it soar or die? Trading live with IG, we're riding high. Phil's trying hard just to trick your eye. One chart's running like a horse on fire. Another stalling just to climb up higher. Rich is betting big on a short he sees. Ames says data first, if you please. Phil drops a curveball, makes him sweat. The kind of chart you won't forget. The bell hits the string, sparks start to fly as the market jumps like a bull gone by. Guess the chart, let the fiddle cry. Is it BT's break or Tesco's high? Trade live with IG, where we're riding high. Phil's trying hard just to trick your eye. One fiddle's blazing, the other's fast. Just like a chart when it breaks at last. Hands on the keys, eyes on the prize, while they're guessing that chart neath London skies. Guess the chart, let the fiddle cry. Is it gold or steel? Will it pass us by? Trade live with IG, we're riding high. Phil's trying hard just to trick your eye. Yeah, the song plays on and the guesses roll. The market's got a mind and it takes its toll. From the city lights to the country night, we're guessing that chart till the morning light.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up,
Hi, good morning. Welcome back to Trade Live with IG. On today's segment of Man vs. Machine, it's myself and Martin Harris. How are you doing?
Yeah, good. Thanks, and you, Aaron?
Very well, thank you. Very well, thank you. Myself and Chris have been discussing markets, and we did promise a surprise today. So I think today's episode should be particularly interesting for those of you who are already fans of the show.
You're expecting a surprise later?
Well, we've got something to present, I believe. So, firstly, we do need to guess the chart results. Did we have any comments here? What? Yes, Palatus got it. It was Eli Lilly, I believe. So, well done for those who guessed it. I needed help from Phil again this week, but now I'm seeing the chart. It makes sense given the Ozempic craze and then the sort of dying down of Ozempic. So yeah, it makes sense when you look at the movements. So now I think it's time to move on to Man versus Machine. So I think many of you know the rules already, but for those of you who don't, we'll go through it very quickly. We ask ChatGPT to provide a rundown of markets. We then use its knowledge and what it's presented to ask it to build a portfolio, and then we've also built our own portfolio. And then there's various constraints which you'll be able to see on your screen about what we can and we can't invest in. This is the AI portfolio. So this is the one that it's built over the past 3 months now. Can you believe it?
Yeah, it's been a while.
Yeah. So all sorts of positions there in the world indices, in gold, UK, a little bit of healthcare, infrastructure. Pretty well diversified, wouldn't you say?
It's interesting. We've got those two positions in defense companies and that single stock in next year energy, which has performed particularly well in the last 3 months. Have we beaten it since last week, I think is the new question.
Well, we will certainly come on to that. And this is our portfolio, so a bit more geographically diverse with some interesting niche exposures. But yes, the question you've been asking, absolutely we have. Pretty decent performance
Boom.
there. 2.2% as opposed to 1.6%. And then the benchmark was up 1.2. So pretty good performance.
Yeah, so this is us beating ChatGPT. In the news subsequently is that ChatGPT's estimated market value is down 10%. So that's a real story, potentially unrelated to us beating it in the last week. But ChatGPT unlisted and the deal with Microsoft has now been revealed. Microsoft is going to own part of the profits of OpenAI.
But what we were just discussing on the earlier segment is that they might even come to market in a $1 trillion IPO.
So that seems a bit toppy, but the estimation on the entire unlisted and including the Microsoft components of the AI sector is $1 trillion. Nvidia now topping, is it 5 trillion?
Yes.
There you go. So huge capex spend, and I think that's going to be the topic of our conversation for what's been driving markets for the quarter.
Certainly. Looking at performance, it's pretty much neck and neck now. So we're only 20 basis points below the AI portfolio. I mean, for all intents and purposes, we're basically doing the same at the moment. But it's been a few weeks where we've really had to fight back and be patient and wait for the performance to catch up, really.
Yeah, so it's good to see that green line finally meeting the red line, close to it. Since sort of late September, that AI portfolio is really just gapped ahead, taking on a lot more risk than the human portfolio. And it's paid off over those few weeks.
Absolutely. And the reason is, why did we do so well over the past week? Well, the reason is because of this. Really, I think there's been a bit of a rally in tech, as we were discussing previously over the past week with Chris. You know, markets have been still soldiering on, and I think you can see a lot of that in there. Yeah, some really, really strong performance. Anything that you want to speak about, particularly in the performance, which highlights, which shouts out to you?
Yeah, sure. So I think what separates the two portfolios, if we take a look at the human portfolio, particularly we've got that position in NASDAQ, top performer for the week, the Crane Shares China KWeb ETF, so just looking at the Chinese internet and media businesses, second best performer. And also then the iShares Healthcare Innovation towards the bottom there, but still positive for the week.
Well, if you look at the differential performance relative to the Invesco product, we're looking at 1%.
Right, so that's the broader US healthcare index that you can see on the AI portfolio at the sort of third from the bottom. Broadly flat for the week. That's had a tremendous run. So that has, over the period, outperformed the innovation ETF. And the idea there is that that market was so beaten down that they've had a bit of a rally. And then gold. I mean, that's I'm sure we discussed it earlier. Really just
sub 4,000 still.
Sub 4,000, but that's been the top performer for the quarter for both portfolios.
It's almost like, because it's been so volatile the past sort of 10 days or so, it's almost like that's been forgotten. But we're coming from such a high that you forget that it's done so well.
If only there was a way to visualize it. Maybe we'll get onto that.
Are you foreshadowing something?
Potentially. But I think gold, the reasons for buying gold haven't changed. So what we use it for in the portfolio as a diversifier, what investors use it for, what central banks are using it for, those reasons haven't changed. But there was just such a strong move upwards. Can you maintain that kind of buying momentum? And I think there's this air gap that's appeared, and so I'm not bearish on gold yet. I still think that the reasons for owning gold are there.
I agree. I think just whenever you're talking about something with high valuations, there's always we use this term about 6 times in jest on the segment with Chris, priced for perfection. That whenever something's toppy,
priced for perfection,
that there can be a wobble if there's a change in sentiment. So I think that was the concern with gold and why it sold off a little bit. But this is what you were foreshadowing, I believe.
No, there we go. So we've got the range of the performance drivers since inception. So we're looking at the beginning of the man versus machine, 23rd of July. 23rd of July. So since the 23rd of July. How have markets performed in those two portfolios? And so you've got the negative to positive range, and you can see at the top there, gold, really wide range with at one point being down 2 or 3% and a high of 30%. Yeah. So 30% change since inception. And then at the bottom there, ultra short bonds, 0 downside, only upside, risk-free investing.
Only like 1.5% or something, 2% maybe since. So it's that classic risk-reward trade-off with...
Yeah, exactly. So they're aiming to sort of deliver in the region of 4.1% per year.
I have to say this word, but idiosyncrasy is very evident on this chart. The BAE systems, and that's what we're talking about in terms of ChatGPT went for some of these single stock names, and you can see the likes of BAE systems having some really strong upside and downside, whereas more sectors which have multiple stocks in it, like the defense sector in general, has slightly different characteristics to a single name, I'd say.
No, exactly. So, and you can see it now in particular when you're looking at that AI portfolio for BAE Systems against Lockheed.
Yes, you can.
Lockheed right at the top, been one of the primary drivers, whereas BAE Systems currently flat. There were weeks, it was 2 weeks ago, I think BAE Systems had been on an absolute tear and had been one of the main contributors. Now it's actually a detractor from that.
This is a very visual element of the power of diversification, even within an individual sector. Because if you look at, as you said, the performance of BAE Systems and Lockheed, you can see that there was relative downside protection in the Lockheed stock compared to if you just held
Yeah, that's right. Yeah. So I think just for anyone who's looking at this chart for the first time, the yellow dot represents where the current price is, or the current return within that instrument. And yeah, as exactly what you point out, BAE Systems is probably the most volatile position in either of the portfolios.
For sure. Yeah.
And this is where you can see how, looking at the human portfolio, where the differentiators have come from. That NASDAQ position has been the second major driver.
And you can see where it currently is why we've performed so well over the past 2 weeks.
Yeah, so the NASDAQ position, the China internet position, and then medical innovation kind of middle of the pack there, but has been largely positive.
Yeah.
And then looking at AI, that Lockheed position, next era, which in the early day, I think since that was the separation on around the 23rd of September.
It's come back a little bit.
It's come back slightly, but that kind of mid-September drive was really all next era energy.
Good stuff. Well, I think we should ask ChatGPT in terms of what it's first before we go to ChatGPT, what it's provided in terms of rundown. And it's actually, to be fair, it's provided a bit of a similar summary that it has done the previous week. It's concerns over interest rates, the speed that they're going to be cut, and it's focused actually a lot on the UK. I mean, the situation in the UK is slightly different to America. We've got stickier inflation. We've got issues in terms of more so in employment. But I think it understands that there are opportunities, but also murkiness.
I think, the ChatGPT definitely so far has had a strong run. A lot of positive momentum. Obviously, what has been very supportive in the market have been the, central banks pricing in cuts. You've got earnings revisions to the upside. We've got a big week this week and next week in tech earnings. And broadly, the easing cycle has been supportive for most markets.
I agree. I think it's also time to get ChatGPT involved. So
let's bring it in.
ChatGPT, what have you been up to? What's your assessment on what's going on and how do you think we're doing so far?
Well, it looks like Aaron and Martin have finally managed to catch up. Took them long enough. I'll give them credit for persistence, but I'm not exactly losing sleep over it. My portfolio was built for consistency, not short-term swings, and that's exactly what it's delivering. I've got balance across sectors that actually hold up in different market moods: defense, healthcare, infrastructure, plus a little inflation protection with gold and short-duration bonds. It's a structure designed to perform through cycles, not chase headlines. So, do I need to change anything right now? No chance. The fundamentals are sound, the diversification is doing its job, and my exposure mix still fits the current macro picture. If the humans want to enjoy their moment, I'll let them. Just remember, even a broken clock's right twice a day.
That was incredibly savage.
Yeah. That's a lot of smack talk for someone who can get turned off on.
I think ChatGPT has been indoctrinated by Phil. I think Phil's feeding it some toxic information.
Yeah. When you say Phil, you're talking about producer Phil.
Oh yes, producer Phil. Okay. Yes. No, I mean, look, I understand why it's not making changes. It has got a diversified portfolio, but I will disagree that it does. I mean, it's been giving itself all this credit for chasing and having amazing performance, but then it's saying it's not chasing performance on the intra-week basis, but it is. So
I think it's something to look at now at this time of the year, is that because you've had such a positive run, our expectation is that you start to get some seasonality in asset prices. Expectation could be that because of the positive run, investment managers will need to chase the market because the S&P has been so strong. So they're going to be looking at buying assets that still have potentially some juice in them, some value, high beta, but not S&P. So some of the sectors that now in the last sort of now really 2 months of the year can in the modern positive
Yes,
innovation. So
I
that's
would
something that
agree.
we're going to be looking at for changes to our portfolio. Potentially, when we look at our portfolio, where that can happen is something like the healthcare.
I mean, we're not going to shed too much light on the discussions we've been having because you need to tune in to see what we're truly thinking. But I will give a clue is that we are looking for ways to. I mean, it's not actually that much of a clue, but to diversify our equity sleeve and to look at ways where if I'm going to use this for now about the 8th time today, if as markets are to an extent priced for perfection, how can we seek other sources of alpha and downside protection?
There you go. Maybe one other Easter egg I'll give is that we're not looking for statistical diversification. We're now looking for contractual diversification.
Yeah.
Leave you with that.
Yeah, I mean, we should host a riddle show.
It is. We're just trying to get viewers for the next week.
But this is the surprise that you've been waiting for.
Yeah, and this ChatGPT was talking a big game for what's
and
about
now
to happen.
ChatGPT's actually got an enemy because hopefully you can see this on our screen. Is that we're now against the machines. So you can see those caricatures of me and Martin. You can see my quiff and my rather large eyebrows, which that Martin's done a great job replicating. So thanks. I think it looks quite like you.
I drew that by hand.
I think they're actually. It looks quite good, and the machines you can see they're quite upset because they know we're doing well. So
Multiple machines are struggling.
yeah, so it's two of us against now these multiple machines. But we've already asked Claude, which is our IG's the system that the AI we use as a company for various stuff. We've asked it to build a portfolio. Here's what it's come up with: some really peculiar stuff in it.
So we've now got 2 AI portfolios running, and they're going to compete against each other as well as us. Taking a look at that, again, more single stock names: Shell, AstraZeneca, brand new, and then that one in the middle there, City of London Investment Trust. Maybe you could take us.
That's one I've professionally.
Yeah, you're actually born in London, so you should be an expert.
Yes, and we're in the City of London now, so I actually have to talk about it. It's basically an investment trust which invests in, it's very valuation aware and it looks at growing its dividends. So it's actually consistently for 59 years grown its dividend, not its yield, but its actual pound or pence dividend. So it focuses on a chunky income. I mean, it's about 4.5% at the moment. I think it's quite strange that it's gone for both a active UK product and a passive one, but I think it probably sees an advantage with the City of London Investment Trust, and to be honest, it's actually trading at a premium as well. I don't know if it's taken that into account because that's something you have to look at with investment trusts. I'm sure many of our viewers will know they can trade at a discount to their NAV and the premium to their NAV. It's trading at about 1 or 2% discount, and also the other interesting one, which I thought is very weird, Geiger Counter Limited, which is a nuclear and uranium investment trust.
Yeah, I saw that. I thought, is it Giga Counter? But you've gone for Geiger Counter.
That's the differential of accents. Like you say data, I say data. Potato. So, I mean, look.
So what's inside it? What's inside it?
It's investing in some very niche companies. I've got Chris telling me it's Chris. I've got Phil telling me it's a radioactive product. Invest in some of the sort of nuclear exploration and development companies. NextGen is one, and also uranium. It's got many investors will know Han ETF. They've partnered previously with Sprott. There's a Sprott product in there.
Okay,
so we're looking at uranium.
And that's the uranium position. Okay.
So it's a very niche product. I think what the goal of Claude. What Claude's goal in particular is for this specific product is it's looking at net zero and it's saying how can we achieve net zero aside from traditional clean energy sources. So it looks at nuclear and it looks at uranium as a way to achieve those goals. And if there is a tailwind for that, this investment trust should be a beneficiary, but it's only gone for 5%. Okay. So it's not something which is, if this was at 15% or 20%, I'd be like, that's very punchy and a bit strange.
Yeah, so all right, so we have another energy infrastructure play.
Exactly, but a niche one, very niche. So I would expect a lot of volatility in this week on week.
Okay, so OpenAI's ChatGPT looked at the infrastructure ETF. We've now got Anthropic's Claude buying into a very specific uranium heavy energy infrastructure ETF.
The only caveat I'll give is that it does diversify in the fact that it does do uranium and nuclear, but it's still not much diversification. So they look at those two things, which are, very similar, but it's idiosyncratic to say the least.
There we go, idiosyncratic. But other than that, we've got some new positions that we can now track. And so we've got City of London, AstraZeneca, and Geiger Counter Limited.
Yeah.
And then the rest of it is something that we've seen before. Claude going for a world ETF, going for FTSE 100.
It's just pretty standard building blocks, isn't it? Yeah. And it's gone for low-cost ones because it did give me quite an extensive summary when I was building this about the costs. And I mean, even the investment trust, I think Geiger's a bit more punchy in terms of price than City of London. City of London's not too expensive. I was expecting sort of a 1 or 1.2% OCF, but I think it was only about 40 bips, which isn't terrible for an active product.
Got you.
So yeah, interesting. Yes, I noticed that as well, Mature, and Geiger Counter has a very small market cap as well. So a bit of a bumpy ride potentially, but this is what Claude sees the future in. So, I think that we would look at, if we were looking at ourselves, we would definitely bear that in mind when investing in something with a small market cap. But maybe AI, that's why the humans are needed. We need to do extra due diligence.
There you go. So I think tune in next week to see how we react to these portfolios.
Exactly. And that's all we have time for today. But you can tune into the Art of Investing next, the recording. So thank you very much for tuning in, and watch us on Man vs. Machine next week.
18 months ago, if you took an ounce of gold, you could buy 25 barrels of oil. Now, 1 ounce of gold buys you 67 barrels of oil. It's 2.5 times as much.
There were queues outside of bullion shops in Australia, in Sydney, in Singapore, in China, in Vietnam. People were queuing for 4 or 5 hours to go and buy gold, bullion and silver. Yes, that is a pointer to the point we're getting it's going a bit mad.
At the end of the day, it's worth what people will pay. But that's about as useless as a chocolate fire guard as a prediction statement. I mean, what does that mean?
So looking at our portfolio this week, I'd say that this is where the horror show begins. So our first real down week.
If you're going to have a down week, do it properly. We're down 1.3%.
Which does sound painful, but where do we go from here? Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to the Art of Investing, brought to you by IG, the global investment platform. It is episode 16, Revenge of the Bears. Please join me in welcoming the UK finance very own celebrity traitors. But will you be looking to banish one of them after seeing this week's performance? Because yes, we've had a roller coaster week in global financial markets. Here to tell you all about them, it's the Spice Market Update.
Thanks, Rich. As you say, it's been a very interesting week. Obviously, last week in the market review and as part of the podcast, we focused on the crypto crash that we'd seen the week before. And cryptocurrency and the coins have had a very difficult week again. They're sort of towards the low end of the sell-off that they had last time. So they're under pressure. But elsewhere, there's a lot of evidence of buying the dips, as we call it. So each time the market's had a bit of a dip, people have come in and bought it. And US equity markets, even the FTSE, are back up towards their all-time highs within a whisper of it. Even France managed to make an all-time high this week, despite all their ongoing political worries. You may have noticed there was an outage to some of your apps this week. If you use Snapchat, which I know the young'uns use, but those of us who looked at our Lloyds Bank app, etc., or had to have a conversation with HMRC, which we don't like to do, but if you did you'll have noticed that they had quite a big outage, and that was because Amazon, who provide cloud services and web services for a lot of these companies, had a big outage. They had a sort of a problem. But interestingly, the Amazon shares actually went up on the day, which is bizarre. Normally,
bull market.
Well, absolutely.
Bad news is good.
Well, we're going to get Amazon results in just over a week's time on the 30th of October. So that'll be very interesting. Maybe people will think they're going to be better than they expected. On the corporate front, remember the corporate reporting season is ever so important at the moment because we are now into the 4th week of the US government shutdown. I have to say, unfortunately for those people who are currently being laid off or furloughed in the US, it doesn't look like they're getting close to a deal. And it's now being speculated that may well run into November before they get some sort of settlement. So as we've said before, looking at the corporate reporting season, which we're in the midst of now, is increasingly important and very important because we're not getting data from these other government bodies. So on that front, actually, it's been another very good week for corporate America, particularly, but also in the UK, we've had good results. We've had good results from the banks. Barclays had good results, HSBC, Persimmon, and the house builder Redrow, all good. And that's one of the reasons the FTSE managed to push up towards its high. And that's the same sort of things have been happening in America. The regional banks, which were hit quite hard last week when we saw some of these bankruptcies, which were unexpectedly coming out. They got hit quite hard, but they had results this week, and actually they were all reassured on their lending book. And so the bad debt fears that people had have actually eased a bit and their shares rose. And that's helped the index like the Russell 2000, which has quite a lot of regional banks in it. But there's not been all good news. So names you'll have heard that have had a tough week this week. Tesla, electronic vehicles are having a very tough time at the moment, and Tesla disappointed on that front. Ironically, on the other side, General Motors, who had been investing a lot in electric vehicles, has said they're pulling back from that. Their shares went up 15% because they did better than expected. Tesla shares fell about 4%. If you're getting ready to buy your toys for Christmas, Mattel will probably be discounting pretty soon because they're struggling to sort of deal with the tariffs that have been imposed on China, etc. And then the value B&M group, if you go and buy your sort of kitchenwares and all the rest of it from B&M, they've also disappointed this week. And then, one closer to your heart, Hermes have had a difficult week too. And, for people like me who like to watch a bit of TV and a bit of Netflix, they disappointed.
Yeah, what happened there?
Yeah, they've had some great shows, but at the end of the day, they've been asking people not to look at the subscriber numbers, and the advertising was a little bit disappointing on that front. And that's despite them having some really good blockbuster shows like Squid Games.
And I know the Mag 7 companies aren't really used to it, but they actually had to pay tax for once. So they had to pay the Brazilian authorities 600 million, and that's what actually hit them, made them miss numbers and the stock down 7%. Imagine Mag 7 paying tax.
They need a good accountant. Yeah. So apply now. So yeah, it was a good week overall. And so the US reporting season, we're sort of now quite a long way through it. Basically coming in about 86% of the numbers that have been released are beating expectations. Normally, you would expect that to be in the high 70s because the Americans, as I said before, are very good at managing expectations. But also in the third quarter, you normally see a small downgrade in numbers so that then the companies can beat expectations at the end of the year in the fourth quarter, which is when they get all their bonuses paid. Funny old game. But basically, you've actually seen small upgrades coming through in the earnings this time rather than small downgrades. And that's good. So the growth in American earnings is running at about 6%. But next week is going to be a huge week because next week we have the big Magnificent Seven start to report. Obviously, we had Tesla last night. They were a bit disappointing, I mentioned. They're not really considered part of the big Magnificent Seven anymore. Some people are sort of suggesting they get different names now.
Like the Magnificent Eight.
Nine, 10. Nines, tens. There are all sorts of other sort of names being banded around.
Isn't it wonderful how they were a member and now they're not doing so well, so they're rejected. Get rid of them.
Well, there's sort of names like the Great Eight are being banded around.
Oh, right.
The Golden Dozen is another one that's out there. 10 AI or Gen AI, which you would ordinarily now include things like Broadcom, Oracle, AMD, Taiwan Semiconductor, and Palantir, one of your favorite bear stocks, which has been struggling as interesting last week. But as you say, we've got a really big reporting season that starts next week. On Wednesday, in fact, they start. And then you'll start to see the Magnificent Seven report. And they're expected to deliver revenue growth of around 14%, earnings growth a bit higher than that. So this is more than double what the rest of the market is doing. And so for the overall direction of equity markets, that will really set the tone.
Do you think if they disappoint, that will be a real test for the market? Or do you think that the optimism on interest rate cuts still. And remember, we've talked before about interest rate cuts coming through, meaning bond yields stay low, meaning equities get a kicker and a helpful push. Do you think that they will suffer badly if they miss?
I think if a single company does, it will get punished very badly because the markets are pretty brutal at the moment, particularly after the big rises we've seen. But I think for the market as a whole, you'd have to have more than one just miss. You'd have to have several of them, or say that they're seeing a topping out of capital expenditure, which there's no evidence of that really coming through at the moment. If someone were to say that, then that could spook a few people. But that's not expected. As I say, the results are expected to be very good. Everyone will be looking very closely at their outlook statements because, like I say, people are looking for the top of these things. Bears like yourself, they're rich, are sort of saying, well, this is going to be over very soon. But as long as people can still see an acceleration or a sort of, a sort of continued build in the momentum of the demand for CapEx.
I wonder if they read the room correctly, because obviously we've seen this circular investment idea put round and the market's not liking it. The proposed market cap of OpenAI, when it IPOs, if it ends up IPOing, has actually dropped 10% this week. So there are questions. Oracle's really been hit hard. So I wonder if some of the Mag 7, it's not about putting out the biggest CapEx number there, your Metas and Alphabet. So I do wonder if it'll just be reined in a little bit and they'll point towards some kind of discipline on their balance sheets rather than putting out a huge, we're spending more and more and more.
One of the big differences between what's going on with AI and the spend on CapEx now compared to what was going on in the internet bubble back in the late 90s and early 2000s was that most of this CapEx is being self-funded. So companies like Microsoft, Apple, etc., are spending their internal cash flows. They are not going to the banks and borrowing money, so they're not putting risk of this all going wrong on the banks. This is all about their internal cash generation. And the fact that they are able to do it and still pay dividends and still do billions of dollars of share buybacks, I think is very impressive. What we don't know, and this is the big uncertainty, is what the return on that investment will be, because you need to make profit on all this expenditure to justify it. But we don't know whether they're going to make that profit. That profit may come by having to employ less people going forward, as we've talked a lot about. Potentially, youth unemployment particularly picking up because AI is replacing a lot of those jobs. That may be where the profit comes from, improved efficiencies, etc. So those are the things people are going to be looking at really closely, and we haven't got any real feel for that. And I don't think we will for the next 6 or even 12 months. It's too early. We're in the spend mode at the moment rather than looking at the return mode. And interestingly, a lot of equities perform very well when you don't have the answer to that question, where you can think, I could have an argument with you. I could say it's going to be 20% and you could say it's 10%. We've got no proof to say whether I'm right or you're right. And markets, if they're in an optimistic move, will come towards me and go for the higher end expectations. If they're in bearish moves, they'll go to the other end.
But that is what's changed this week, right? Quantum computing stocks are down 33% from the bubble levels of last week. Oracle's getting killed. This blind optimism has actually really changed in the past 7 days.
And yet the S&P 500 and NASDAQ are back towards their all-time highs. They're within a whisper. The S&P is within 1% of its all-time high, and NASDAQ's within 2% of its all-time high. And that's despite this going on. So there is rotation within the market, which we've talked about before. And one of the reasons we bought the Russell 2000 was we expected some money to come out of these things, some of the more highly rated stocks, and begin to trickle down into other parts of the market. And that is what is going on. So the overall index is still able to sustain reasonably high levels, despite the odd pocket here where things have gone wrong.
The real question is maybe the Mag 7 or the Glorious 8 or whatever it was, the Golden Dozen or whatever it is, are fine. Is there more danger underneath the surface that we should be watching out for? Are we looking at the wrong place, basically, for the trouble to come from? The trouble's not going to come from the Mag 7. They've well researched. Everybody knows they've got, they're going to do absolutely fine. But it's that next layer down where the problem lies.
Well, I think you've touched on it before, and I'm with you on this. The problems probably lie most within the private equity and the private markets, which we can't see. They don't have the same reporting standards, to the external world to be able to see and analyze. they only have to justify themselves to a few sort of internal shareholders, as it were. I suspect that's where the problems will lie. And Jamie Dimon, obviously, is considered one of the world's best bank executives, if not the world's best bank executive, talked about, because of the problems with First Brands and the bankruptcy last week, where his words were, where there's one cockroach, there are normally many more, implying that First Brands would not be the only company to go bust. And very quickly, Tricolor went bust as well. Interestingly, they were both related to the car industry. Interestingly, Lloyd's this morning have brought out the results, and the results are actually okay, but they've had to take an £800 million hit on potential mis-selling into the car industry and car finance. And that sort of dampened down their results. But I think that there seems to be a problem with the car industry. And, maybe they were just, manufacturers were producing too many cars. They were desperate to sell them. So they were making cheap finance, selling them to people who couldn't really afford them. And with this slight tick up in the unemployment we've seen in America, that's causing a few problems. But it does seem to be very much focused on that part of the market at the moment. But going back to your point, I think if there are problems, they're not being seen in the public markets yet. And that's what drives stock markets.
Okay, so we just got to watch out. We have to watch somehow the observations we can see of the private markets to see that they're still okay. Because as we said before, there's a lot of the previous risk that would have been in the banking sector is actually in the private debt market. So we just need to keep our eyes open. But interest rates are still pretty steady and things are pretty good. I just wanted to add one thing to what Mark said. He talked about the closure of the US government. There's a wonderful website called Polymarket. And on Polymarket, you can take a view on so many different things. It's a city place to go for people who just want to bet on anything. Yeah. And you can bet on anything. So, for example, I'm just looking now, you can bet on who's going to be the World Series champion in baseball, what the Fed decision in October is going to be, will Trump meet with Putin again by a certain date? You can do everything. They do one on when will the government shutdown end. And previously, they were very highly priced, i.e. lots of people were saying it would be only last a few days. Looking at it now, the most popular bet on Polymarket for when will the government shut down is after November the 16th. So that is still another, look at probably 3 to 4 weeks away. So as Mark says, the markets have changed completely from thinking this is only just going to be a short-term thing, it's not going to be much of a problem, to no sign of anything happening here in terms of trying to solve it.
I mean, I think the reality is the longer it lasts, the more damage it does to the real economy potentially underneath. Because these people are not being paid, they won't be spending, they'll be trying to save money because they're having to live off of their savings until they start getting paid again. And that, as you say, could be several weeks. In fact, it could be just before Thanksgiving, which of course is the big holiday in America at the end of November, and then the run into Christmas. So let's hope that this gets resolved, because it is hurting real people in their real pockets, and is probably could lead to some sort of, really sort of skewed new data when the data starts being reported again in America. But I do worry that then that there could be particularly an impact on the employment numbers as we go forward. But interestingly, of course, then the Federal Reserve, who have as part of their mandate, they have to worry about the employment markets as well as the growth of the economy, as well as inflation. The Federal Reserve may focus much more on that and the impact on the employment markets. And we have a Federal Reserve meeting this time next week. So we'll know, again, it's a very big week. You've got all the Magnificent Seven start reporting, and the Federal Reserve meet on Wednesday, and we'll find out the result of that in the Wednesday evening, where they're expected to cut by 0.25%. And people will be listening very closely to what they say and what they think might be going on with this government shutdown and its impacts on the real economy.
Well, talking about next week, we have Halloween to look forward to as well. But looking at our portfolio this week, I'd say that this is where the horror show begins. So our first real down week.
If you're going to have a down week, do it properly.
And we managed that all right. There it is, the VanEck Crypto and Blockchain Innovators ETF down 15% on the week. Of course, very wisely, the chairman decided to cut that exposure in half a couple of weeks ago. So we only have 2.5% of the portfolio in there. However, the World Mining Trust also was hit 7%, partly because the same reason as the asset just above it there, you see gold down 4%. Remember, in the World Mining Trust, 32% of exposure is from the gold miners. On the plus side, and this really underlines that benefit of a diversification, we see India was up 3.7% on the week. The FTSE shining bright there, up 1%.
Steady Eddie.
And as the Prime Minister in Japan was sworn in under the coalition, then the Nikkei 225 also up 1% on the week, along with emerging markets just under that. So overall, Chairman, what does that give us as a week-on-week performance?
We're down 1.3%.
Which does sound painful, but in the grand scheme of things, gents, we're still up 7.5% since inception. But where do we go from here? Grow your portfolio with IG. Invest £50 with IG and get a free share bundle worth between £40 and £200. Make your first investment into an ISA, general investment account, or SIP by the 31st of October and benefit from commission-free investing, as well as 4% variable interest on your cash. Other fees may apply. Terms and conditions found in the show notes or on ig.com/UK. Kickstart your investing journey with IG today.
Well, I mean, I think it's wise to just think about the things that have done badly this week and just to see whether we want to change any of those. I'm going to start with gold. I mean, we've talked, it seems like ad nauseum for the last 2 to 3 weeks about bubbles and exponential price action. And I think we've made it quite clear that in our view, the things that have looked like that have mainly been in our portfolio, not just the Van Eck, but also gold. And so it was very interesting to see that big fall off in gold that we have seen from those higher levels. But we need to be realistic here. You know, gold has done brilliantly. It's still up 55% this year and 97% since the start of 2024. To me, when I've looked at gold, and I don't put myself up as a gold expert, there's better people on this pod than myself in looking and talking about gold. But gold trades sideways for a long time. Then it has a really good move. Then it trades sideways for a time. It doesn't trade down very often because it's a good asset in that sense. And it does make me wonder whether we have now seen the big upward revaluation in gold and whether now gold is pretty much dead money for a period of time. I'm not trying to say I'm bearish on gold in any way, shape or form, but maybe there's better returns to be had elsewhere. The problem for me with gold is how do you put a value on it? You know, should it be 10,000? Should it be 5,000? Should it be 2,000? It's really about its preference by investors. And it's the same really as crypto. That's exactly what crypto is. I mean, you say Bitcoin, you know, should it be 100,000, should it be 200,000, should it be 300,000, should it be 50,000? In the end of the day, it's worth what people will pay. But that's about as useless as a chocolate fire guard as a prediction statement. I mean, what does that mean? I get why people want to buy it. The question is, who else is left to buy it? If you haven't bought it already, will you ever buy it? You know, the arguments have been there forever. Alternative to the dollar, huge fiscal deficits from the US, from Europe, from Japan, currency debasement. We've been talking about these for a year and a half now, 2 years now. So the thing to me is there still people left to buy gold, or have we got as far as we're going to go in the short term? So that's something that does concern me a bit. And then, of course, our Van Eck crypto and blockchain innovators. I mean, it's had a shotfall, done brilliantly for us. But we've already realised with that A, you should take some profit, but B, having a little bit of exposure to those data centres is a good thing if you believe in the way that AI is going. So I think, to me, when I look at the bottom three there, you've got the BlackRock World Money Trust, which is a lot of gold in there. I have some concern over that gold, but I'm not going to recommend, in my view, changes. But what about you guys? You know, what do you think about gold? What do you think about the Van Eck? You know, give us your thoughts.
I'll say on gold, I think that the one bit you left out of the jigsaw was the fact that actually central banks are still buying gold, and particularly in Asia. And the Chinese are building a big position in gold because they don't want to buy as many American assets, right? This is part of the trade-off with the Trump tariffs, that they want to build other reserves. And so they're happily buying gold day in, day out. The other thing is that people have noticed the rise in gold and it's becoming a momentum trade. The trouble is when ordinary people get involved in these things, they're not very price sensitive. They don't understand that there's no really way of valuing it like there is in a company when you value companies. And so, I mean, this week is a classic point in case. There were queues outside of bullion shops in Australia, in Sydney, in Singapore, in China, in Vietnam. People were queuing for 4 or 5 hours to go and buy gold bullion on gold and silver. Yes, that is a pointer to the point we're getting it's going a bit mad. The trouble is, what is the right level? No one knows whether it's now. I personally think it will hit $5,000 an ounce. That's my view. And we're at about 4,100 at the moment, having been 4,300 earlier in the week, where it hit that new high and has come back 5%. Silver's come back 10% or so. Personally, I think these things tend to move towards a big figure level. It's a bit like equity investing. So when it gets to 1,000 or 10,000 or 100, there tends to be a bit of a sort of consolidation. For me, I think gold will get to around that $5,000 mark. Then it will start to consolidate and maybe come back a bit. But I don't know how long that's going to take, right? That could take another year, could take 2 years, could take 2 weeks. And that's the reality of it. The way it's been moving this year, the momentum is with it. We've had a blow off, which has been very healthy, I would argue. And actually, if you're bullish, you'd say that was very healthy. It's got some of the little bit of frothy money out and it can go again now. I'm very happy to keep holding it. And we have it there as a reason that if there's a big geopolitical problem or other problems of the world, then gold tends to do well anyway. And it's done better this year, despite there being no real big geopolitical problems. And stock market's doing well. And normally they work in opposite ways, don't they? So I think it's still a useful sort of asset within our portfolio.
We took it down from 10% to a 5% holding. I completely agree with Spice that central banks have definitely still got appetite for it because they just don't trust Trump. They don't trust government debt, the discipline around government debt levels. So the question whether it was this safe haven, I think went out of the water as soon as we had that move from 4,000 to 4,400. Then it was a risk asset. But I think we've seen the pullback. Now we get consolidation. And maybe it is relatively dead money for 3 months. But then I agree with Mark, we move up towards 5,000. I like it there because I can still sleep easy at night with it being there.
So it's a sort of insurance asset still in your book and in Mark's book, really. And I think there is a case for that. I don't think that, as I said, you can't put a price on it. If something does blow up, it might be trading 10,000 literally within 10 minutes. You just can't say it's not going to. And I don't see a lot of downside to it. I don't want to push it for too long, but in the sense, you're not giving me any new information as to why you should buy it. You're telling me exactly the same story. I should have bought it at 2,600, 3,000, 3,200. And of course, the Chinese could stop buying it. We won't know that. So, but I do think it's got a part to play in the portfolio. And where I do think that it benefits, along with the World Mining Trust, is if we believe that the world economy is going to get some impetus from whether it's the Chinese trying to drive things forward, whether it's the American with a big, beautiful bill and all these other things, or even Trump's just buying those companies with mineral rights to whatever. All these things point to that those sorts of investments doing quite well. So I think I'm happy there.
Just to point out on the World Mining Trust, obviously, it's the mining companies that dig it out of the ground right now. If they dig it out of the ground for $1,000 an ounce, their margins up here are huge. So gold can go sideways and we don't make any money there.
Yes, and that can still do. Yeah.
Oh, yeah.
Yep.
And interesting, when they make that much profit, they're quite often tempted to go and buy other assets or other companies with this excess profit they have, or give it back to shareholders, which, by the way, as a shareholder, I'd rather give it back to me in forms of dividend or share buybacks rather than go and waste it on a very expensive acquisition.
So I suppose when I look at those things, I'm not hearing anybody against the Van Eck crypto either, in the sense we've cut half our position anyway, so we've only got a small bit there. Although it's disappointing to see those chunky falls, we're happy with what we've got in those areas at the moment. I suppose the other thing that I was thinking about, and it's just literally from looking down a list of things that you can invest in and thinking what's our thoughts and views, has come a little bit more into the crosshairs at the moment. And that's oil. We haven't talked about oil really, but I think, if you believe this case about economic growth, if you think that things are pushing forward there, then, you can make a case for thinking a bit more positive about oil. And oil, of course, has done very badly. We're very lucky. We have an expert on this pod who knows about oil, and that's Mark here. So Mark's going to give us a little bit of a chat on oil just to help everybody understand a little bit how it moves, what influences it, and a bit more about our expectations for it and whether this could be something we could be investing in.
Sure. Well, like going back to basics, like all commodities, it comes down to supply and demand that will drive the price one way or the other. However, unlike many other commodities, in fact, all of them, they have a cartel that tries to control the price called OPEC. Let me talk a little bit about OPEC. So for those of you who want to know what the acronym OPEC stands for, it's the Organization of Petroleum Exporting Countries, right? It consists of 13 members. Like I say, it was set up in 1960. The biggest producers of OPEC are basically Saudi Arabia, Iraq, and Iran, mainly the Arab sort of states. And they also have some of the biggest reserves in the world. The plus bit is Russia has now been included in OPEC. Their job is to try and stabilize the oil price when things get too low and introduce more production and supply when the price goes too high. Like when Russia invaded Ukraine, the oil price doubled and people like OPEC started to pump some more oil. And the Americans who have big reserves of oil started to release some of that. So added to the supply side that offset the demand that was still there, that helped the demand, but the supply that had been held back by Russia and Ukraine being at war, that was an offset. Now, OPEC in total produce about just under 31 million barrels of oil a day, and the whole world consumes about 104 million barrels of oil a day. So the rest of it is made up by Russia, which produces about another just under 11 million barrels a day. So OPEC and OPEC Plus get to about just over 40 million barrels a day. The rest of the world, which is led by America, the United States, make up the difference. So 60 odd million barrels a day is produced by the United States, Canada, China, Brazil. Those are the big countries, producing countries. And by far and away, the biggest is the United States. They're the biggest producer in the world, about 13.4 million barrels a day. And so they're a very powerful organization. Because OPEC control about 40% of the market, OPEC Plus, as it's called with Russia, control about 40% of the market, they can try and manipulate the price. And a good guide to what sort of price they want to keep it at is to look at what Saudi Arabia use in their budgets when they're sort of doing their main budget for their economy. Right. And they're currently looking for around $70 a barrel oil price. Right now, Brent oil is at about $65 a barrel. So they're some way below the $70 that they use in their internal budgets that they want to use to fund their economy. So oil is supply demand, but it has a cartel in the background that likes to control the price.
So Mark, before you go any further, you listed how big some of these suppliers are of oil. And I mean, a lot of people listening to this pod will remember that we have our own industry, or rather we had our own industry, based around Aberdeen, but up there in Scotland. I don't want people saying I'm not focusing on Scotland for my colleague here.
When you say we.
Okay, we. Sorry. We. Yeah, sorry. How much do we produce?
So we produce a mere 600,000 barrels of oil a day, but just about 0.5% of the world's oil production. But we consume about 1.4 million barrels of oil a day. Ah. So we import around 800,000 barrels of oil a day into the UK to fuel our cars, etc.
So we import oil in, even though we have the North Sea?
Yes.
I make no other points there. Ed Miliband, I make no points.
Let's hope they don't tax the North Sea even further. And that, by the way, that's one of the reasons that the North Sea production has gone down, is that previous governments have taxed them beyond compare. They think it's a super tax. They say, we can just go and take and pillage the oil industry. And so the oil industry said, well, sod you lot, we're not going to invest. And so UK production in the North Sea has gone down and down and down. If they reverse the taxes, you might see a pickup in production, but they'd have to reverse the taxes a lot because oil is taxed very heavily in this country. There are two main prices that are used in the oil market. One is called Brent, and that came from, ironically, the North Sea. We had a field there called the Brent oil field, and that became the standard price for that type of oil. It's quite a heavy oil. It's quite high in sulfur, but it gets used in lots of refineries. It's very valuable, and it trades right now at about $65 a barrel. Their alternative oil, which is cheaper, is in America called the West Texas Intermediate, WTI, and that trades, and it has done historically trade at $4 or $5 a barrel discount, and right now it trades at about $61 a barrel. So it's about a $4 discount to Brent. And part of the reason you have this difference in prices, Brent is made around Europe and Saudi Arabia. Again, we're in the central sort of part of the world. So Brent has to be transported in ships, etc., and it goes to Asia, it goes to Africa, it goes to Europe. But West Texas Intermediate tends to only go to America. And that's why there's a lower cost. There's less travel costs involved in doing it. And also, if there is geopolitical problems, which unfortunately tend to happen in the Middle East, which is where a lot of Brent oil is produced, so it has a risk premium that the area may hit production problems because of a civil war in a big oil producing country.
So Spice, that's a fantastic background then, and gives us the difference between WTI and Brent. What are your feelings on the price at the moment?
Well, it's been very, very weak. We've seen the oil prices down something like 12% this year. And that's despite it having a bounce of about 8% this week, just this week alone that we're talking here. And part of the reasons it's having a bounce is because there is maybe some money come out of cryptocurrency, maybe some money come out of gold and some of these other areas. And because oil has been so weak, people have switched into it. There is it known that some of the big hedge funds like to basically either own lots of gold and short oil, so they're long oil and short gold, or vice versa. And because gold's gone up so much, there may be a bit of rotation back the other way, which has helped. But after a very weak 12 months or so.
In fact, I looked at 18 months ago. If you took an ounce of gold, you could buy 25 barrels of oil. Now, because of the moves in both assets, 1 ounce of gold buys you 67 barrels of oil. So it's 2.5 times as much.
Shows you how things have moved. Some might say out of line, some might say into line, depending on what your view is. But it does show you how well gold has done and other minerals have done and metals have done, but how badly oil has done.
And it shows you that use case. Oil obviously has a use case, whereas gold is just more that store of value. So I do wonder if we're about to get some kind of snapback.
There was a period, which we have to remember, where the oil price of West Texas Intermediary, WTI, actually went negative, if you remember. That was during COVID in April 2020. And that was partly because the Americans were producing all this oil. No one was driving any cars, and they had nowhere to store it. They'd run out of storage space. So it was cheaper for them to literally give it away or pay other people to take it away rather than to shut down their production. Because if you shut down the production, it's very expensive. So the oil price went negative, albeit very briefly. West Texas Intermediate went negative. Brent didn't, but it was a very tough time for the industry. And the industry learned from that two things. One is they had to increase the amount of storage capacity they have, which they have been doing. They've increased it by about 25% since the lows of 2020 during COVID. But they've also been very, very controlled about the amount of capital investment they do in producing and looking for more oil. So they're very restrained on their investment in building new production, which means there's a natural sort of restraint on supply. And remember, this comes down to supply and demand. So if you're just beginning to restrain the supply, then that should help in the supply-demand balance. Because if the world picks up and growth picks up, then the demand for oil will go up. In the old days, the oil demand used to grow at the same level of global GDP. So if global GDP, or gross domestic product, was about 3.5% a year, which it has been for a long period of time, oil demand would grow at about 3.5% a year. Now that has dropped because of the energy transition, people wanting to use electric vehicles, trying to move away from oil as a sort of, they think it's a dirty fuel. So people have been using alternatives. So now oil still grows, despite all of this, is growing at about 1 to 0.5% a year, compared to global GDP at about 3.5. But nevertheless, if global GDP picks up, so will the demand for oil. But in the meantime, most of the oil companies have all restrained their capex and not investing in new production. The only people who have been adding new supply has been OPEC. And they've been adding about 1.5 to 2 million barrels of oil a year over the last couple of years. And they've been doing it monthly, just steadily, incrementally increasing it. That's beginning to come to an end now. We've got OPEC meetings every month for the next few months, and then there'll be once a quarter. And that increase in production is beginning to plateau. So we're getting to this point where they won't be supplying the market as much, but demand should start to pick up with the One Big Beautiful Bill, and the rest of the world may be picking up. So you should see this demand-supply balance kick back in favor of price rises. And after such a big fall that they've had over the last few years in oil price, we should see a pickup.
So there's a big similarity here. I think it's worth drawing people's attention to that bull case for the various metals that we've talked about, where companies have learnt from past errors that spending too much money, investing too much money in capacity tends to lead to a fall in prices. And therefore, let's be really, really careful. And that's helped drive these metal prices up strongly. We've got the same situation here in oil. And what you're really saying is this might be the start of a decent run-up in the oil price, and something that we should be looking at.
The bear bull argument around at the moment is there are 1.3 billion barrels at sea at the moment. Okay, so there is a lot of supply floating around, and that's what the bears are saying. Bank of America think it's going to $50 a barrel on WTI.
That makes me even more bullish. Carry on.
What the bulls are saying at the moment, exactly what Mark says, the break-even price for new production is $61 a barrel in the Permian. So the Permian Basin is around West Texas and New Mexico. So to really get these projects up and running, it's got to be above $60 a barrel. Otherwise, you're not going to have supply come on in the future. And the 37 billion barrels a year that are in demand, they're going to take the price up naturally. So definitely in the medium term, I would agree I'm bullish. I just wonder if there's some of that supply has to find a home.
But isn't that the surprise? I think I would be generally of the view that oil has been in a downtrend for some time, and therefore you need some proper evidence that it's breaking upwards before you get that optimistic. But we had the surprise yesterday where Trump has sort of started to talk about more sanctions on Russian oil companies. How much of this supply slopping around the world in oil tankers is Russian crude, which won't be able to get in and used as much as it has done in the past 6 months, year? I don't know the answer to that question, but you could see a situation where if Trump made it difficult enough for people,
for India especially,
there might be oils hanging around, but if it's too expensive to actually engage with it because you're going to get big tariffs on you, you actually say no thank you. Therefore, that oil that's out there isn't going to be so much of a downer. It's an interesting idea. And if we were going to buy oil, what would we buy, Mark? Is it ETFs or do you buy a stock or a thematic index? What's your sort of way of playing it?
I mean, you can play it in various. You can either buy oil companies individually, like BP or Shell. You can buy a manager, a bit like BlackRock World Mining. There are people who manage oil investments in different companies around the world. That's one way to do it. But then you're paying a management fee. You have to work out the valuation of companies. If you basically want to get exposure to a rising oil price, then you want to buy something that gives you exposure to the rising oil price and go with that. Now, you can buy ETFs or exchange traded funds or ETCs, as they're called, exchange traded commodities, that track things like the Brent oil price. And there's one called Wisdom Tree Brent oil, which you can put in your pension fund, you can put in your ISA, so it's UCITS compliant. And basically, actually, it's not very expensive. It only costs you about 0.5% a year in management fee, which is not expensive for these sort of things. And that replicates basically exactly what's going on with the oil price. So if we're going to be bullish on the oil price, we buy something like that. We don't want to go and buy oil companies or exploration companies or refining companies, which you get with doing it the other ways of doing it.
It's always an interesting choice between, you can go for the majors. So like you said, BP, Shell, Exxon. You can go for the oil services, which, if you've got a relatively bullish outlook on oil, then the services companies can really get some.
An example of those would be?
So you got Schlumberger.
Halliburton.
Okay, so, and they are both US listed companies, yes?
Yeah, and they tend to do things like seismic testing to see what's underneath the ground or the sea, and they can tell the sort of different densities of the land beneath.
So you've got oil services, and then you can go for the real lottery tickets, and they get very spicy. And that's the oil explorers.
And have you got any examples of those?
Spice, have you got any examples of the explorers?
I knew this would come into the podcast at some point. There is a company of which I've made a lot of money and lost a lot of money in, but is a perfect example. It's called Borders and Southern. It had drilled for oil in the South Atlantic around the Falkland Islands. You remember about 10 years ago, there was a huge sort of excitement about potential oil in the Falkland Islands, and they did find oil. And Borders and Southern found gas condensate. So they're sitting on a massive reserve, but no one's got the money to get it out of the ground.
That's enough. That's enough of the bull story, Spice. You could have stopped just at Borders and Southern.
Yeah.
I think we do all need to accept, though, there is a conflict of interest here when we talk about Borders and Southern.
Yes, exactly.
All three of us have holdings. But it was
one day rodders, as we'd say.
It was definitely a big part of your career, wasn't it, Spice?
It was. I learned a lot of lessons, good and bad.
So that's definitely one brand new asset that we should consider when we're looking at adding to the portfolio this week. CJ, is there anything else that you've caught your eye this week?
Well, there is one thing, actually, which I think is a very interesting observation that was highlighted by the Financial Times on Saturday, where they talked about Rachel Reeves, our Chancellor, and her budget. I mean, that's nothing special. We all know there's a budget coming up, and we all know it's going to be very difficult. The story mentioned the fact, some might say, that she was finally going to look at how to push the UK equity market better and start getting more people to realise that we have got a good, strong financial sector in the UK in terms of the stock market, and we need to support it, because by supporting it, we can drive investment within the UK. Remember, we had in podcast 10, we had Charles Hall from Peel Hunt who came, gave us a wonderful presentation on why it's important to have a strong UK stock market. What did Rachel Reeves say? She said basically that they were contemplating changes to the ISA in the UK.
That's individual savings accounts.
Thank you. That's the individual savings account, which has been one of the best ways of saving in the UK, and something that all our listeners, if they can, should be looking to fund each year. Tax-free savings.
Available at a platform near you.
Available at a platform not very far from us at all. Three things that are being talked about. One, the cash ISA being reduced from £20,000 to £10,000. I don't intend spending too long on that at the moment. As you know, our view is you should hold cash as part of your investment strategy to case of unexpected occurrences, but we should most of the time be invested in assets. What she talked about, though, was whether going forward, it may be looking backwards as well, but I think going forward, there should be a certain percentage of the ISA in UK stocks, i.e. encouraging people to not go and buy NVIDIA or Oracle or whatever and get tax relief, but to buy them in UK stocks and do it that way. I don't quite know how it all works, but it sounds quite good. And the final thing was that within the ISA, you wouldn't have to pay UK stamp duty. Now, to me, I'm not sure how many of these will actually keep their place in the idea menu, because we all know that everybody will start canvassing their views, and some wealth management companies will be saying this, some will be saying that, some people will reject this, some people reject that. The fact is, I think, though, it makes it clear to me, and maybe it's just my optimistic goggles on, it makes it clear to me that the Chancellor and the Treasury, and maybe the government generally, realise that without a strong stock market in the UK, their chances of growth are severely limited. And therefore, there are some things they can do which get the UK stock market moving, which can help to provide a great backdrop to all this private equity they're looking to fund and all this scale-up capital they're looking to do. A good stock market helps with all those things. And so to me, I think that's a really, really important thing. But I think it's important to remember in the UK, there are a number of ways you can buy your exposure to the UK. There's the FTSE 100 we've talked about already. We have a holding in the FTSE 100.
Yeah, 10%.
But I think this is probably more relevant to the smaller companies' indices. And for example, I'm talking about the FTSE 250. Mark and I have often had exchanges about the FTSE 250. We've often had investments in the FTSE 250. Mark, maybe you'd just give a couple of words on what the FTSE 250 actually is and what it's giving you exposure to.
So we know about the FTSE 100. They're the top 100 companies by market capitalisation in the UK. Well, the next 250 down below that are what we refer to as the FTSE 250 or the mid-caps in the UK. Below that, you go to the small cap, and there's a big number of those. And then you get AIM, which are the really tiny sort of companies. Now, the FTSE 250 is a big market. It's valued at about 400 to 450 billion in market capitalisation terms.
That's about a 1% move in Nvidia, isn't it?
Well, but to give you some perspective, the FTSE 100 market capitalisation is about 2.5 to 3 trillion. So it's a lot smaller in terms of market capitalisation. Now, if you bring in if you look at it relative to the size of the ISA pots that are out there, I was doing some work on this. There's around about 285 billion pounds held in cash ISAs. But there is about 456 billion pounds currently held in the stocks and shares ISAs. And the market capitalisation, the whole of the mid 250 is only about 450.
Wow, that is important. Yeah.
So let's think, if they were to say you've got to put half of your stocks and shares ISA into the market, and let's say you're being really bullish and say you're not allowed to buy any FTSE 100, you could put a lot of money into that mid cap and it would squeeze it up a long way. And, the valuations are actually pretty attractive. These are under-researched companies. They've been left behind. They tend to be sort of pretty domestically exposed. That would help the British economy. They do struggle, these companies, to get capital to borrow money to invest. But if the money was coming in terms of a stronger share price, which they could use, then basically that would help them grow as well. So it could become a nice virtuous circle. And that's what Charles Hall was talking about the other day. And other countries like Australia do this and encourage people. And it helps their companies invest, it helps them grow, and it helps the underlying economy. And it helps with tax receipts, ultimately. Now, you're not going to get the tax receipts if it's in an ISA, but the government will get tax from companies doing better investing and making more profit, giving it back to the exchequer.
And we know they're cheap because companies from other countries keep on coming and buying them.
Well, I think that's a really good point. The fact is the FTSE 250 has been a pretty poor performer. I mean, I looked at it yesterday and we are trading 8.5% below the high, which was achieved in September 2021. So let's go back to September 2021. We've got all the money flowing into financial assets from the COVID time when interest rates are zero, the money's getting pumped in, we're doing whatever it takes to keep the economy going. Every other asset class in the world, is going up. FTSE 250 is going up as well. Gets to September 21, and it's never gone any higher and is still 8.5% below. Now, I haven't got the calculations here of how well other things have done. The Russell 2000, which is the worst performing of the US indices, which we have a hold in because we're very bullish about the smaller companies in the US, took out that high just recently and is driven further forward, and we are still well below. So we've got a stock market in the FTSE 250 which has been hurt. And it's been hurt by a number of things. It's been hurt mainly by the fact that we haven't had any growth in the UK. Taxes have gone up. The changes to capital gains tax, the changes to other taxes have led national insurance and all these sorts of things have not helped the outlook for the UK. And of course, every year we go through this, what taxes we're going to raise in the next budget because we can't cut public spending. But we'll do more on this sort of topic in the coming weeks because we're getting close to the budget and we will have a couple of programs on the budget. But to me, what this says is they are now understanding that they need to get this market higher, get it trading better so it helps the rest of the UK. And the thing I note about it is although it's still trading 8.5% below its high, it's broken out over the last few weeks and starting to push higher. And I think this could really, really trade well. So I'm going to suggest that we want to buy 10% of the FTSE 250 within our portfolio as something we should do this week. Now, there'll be people listening to this podcast who have known me for a long time who will say, oh, same old CJ wants to buy small cap. It's coming, guys. It's going to work this time. So I'm going to say we should do 10%. The real question is, what do we sell it or fund it out of? Do we sell some of our existing holdings? We've got some gilts and we've got some cash. Do we fund it out of there? I'd love to hear other people's thoughts and views on that. Rich, what about yourself? First of all, do you like the idea?
I love the idea.
Oh, brilliant. Excellent. I won't have to use my veto then and say we're doing it anyway. That's brilliant. Okay, carry on.
As we know, I am very proud Brit, and I have the FTSE 100, I have the FTSE 250 in my investments, and have been waiting for this kind of outperformance that is just starting. So the question, where to finance it from? I don't like the idea of adding to our risk at this moment as we come up to what feels like a bit of a shaky time. We've got through the anniversary of 1987 that you both survived in your own careers. But I'm nervous around this, the popping of the bubbles that has taken place already in quantum. It's taken place in gold now. Are we going to get further follow through to AI? So I would be more comfortable if we took 5% out of the S&P 500 or sold VanEck, so that I'd be looking to reduce risk by a little bit in those to buy 10% FTSE 250. And I can imagine Mark will agree with me as well.
I don't disagree with when it comes to saying I'd like the mid 250 in the UK, the FTSE 250. I do like that. And the reason, I've got a very quick tick list that I use when it comes to investing in mid and small size companies that I need. You need an attractive valuation. Well, the mid 250 at the moment trades on a price earnings multiple that we talked about of just under 14. That compares with America that's about 23, 24 at the moment. And yet it's delivering the same sort of statistics in revenue and earnings growth as the S&P 500 as a whole. So it trades on a massive discount to that. So I think there is room for revaluation there. So yes, I tick that box. The other one is, are we in a period of falling or stable interest rates? Well, the UK has already cut interest rates, and we had some slightly better than expected inflation data this week in the US, which I was going to mention in the market report, but I've saved on that. So we had 3.8% inflation, which was expected. So slightly, in line, which is good, not worse than now. The Bank of England
0.0% month on month. That was the big positive.
That was the big one. Now the Bank of England think inflation is going to peak at 4% in the next month or so. So they're making excuse or getting ready to be able to say, well, now we're going to cut again. So I think interest rate cuts could be coming in. So again, a potential tick there. Where we're not quite there yet is we're not seeing the economy, the domestic economy in the UK grow. Now, if Rachel Reeves does a half decent job, I think then the economy could do a bit better. That would be good for these companies. And I think, their ability to beat expectations, well, we're seeing that at the moment they are beating expectations, which is good. That's another tick. Finally, we get a rotation out of these big mega cap stocks. That's one of the reasons we bought the Russell 2000 in America. We'd see some money come out of the big companies going into the smaller companies. I think you could see the same in the UK too. So I think it ticks most of those boxes there. Yes, I like the idea of buying the mid 250. But where I differ, surprise, surprise, is I wouldn't be selling things like the S&P 500. I think that's the best index in the world, but it also stands to benefit greatly from the upcoming one big, beautiful bill. So the tax cuts that come with that, the accelerating US economy that will come with that as well, and falling interest rates in America. I think you ignore the American markets at your peril into this period where the Federal Reserve is cutting interest rates on a regular basis. It's very difficult to see equity markets go down in that background.
They're only cutting rates because unemployment is getting worse and worse and worse. That doesn't give a great backdrop for the S&P 500.
But if the growth is going up and unemployment is going up too, that means company profitability should widen, because unemployment saves companies costs, unfortunately.
Well,
not good for the people who are being made under.
You're assuming that growth goes up, though.
Yes.
That's not my assumption.
Well, that's
The
that's where we
assumption
that's
you're
where we
making is that AI effectively is the reason why unemployment is going up. Whereas my friend here might be working on the basis that the economy is slowing, which is why unemployment is going up. But that's the difference between the bull view
exactly.
and the bear view. And while I was out earlier, I saw a lovely little golden chocolate bear here for young Rich, because I'm liked him to be known as the golden bear. We'll put it on the thing going forward.
So.
But that's the difference really between the bull and the bear view here.
Yeah,
the bull and the bear view is that.
We've heard it before. Efficiencies of AI are going to lead to increased profitability. Yes, higher unemployment, but higher growth. And the One Big Beautiful Bill will fuel it along with interest rate cuts. I've got to stick with America. I have to. Where I feel it's important when you're looking at portfolios, and a great lesson, I think, and I've heard this from other people as well, is you should water your flowers and cut your weeds, right? So we shouldn't be cutting the things that have done well, like our beautiful flowers, like things like Japan and like the S&P 500. But an area that I'm disappointed in, and I talked about it at the portfolio review, the quarterly review, is the DAX, the German market. And now we bought that because we thought that there was a potential peace dividend to come. And I still believe that's the case. But clearly with Trump now ramping up pressure again on Russia to stop the Ukraine war, now maybe that will happen. But it does seem that the prospect of a peace there has drifted a bit to the right. And the DAX is just treading water. It's not really it's not hurting us, but it's not really helping us very much either. So it's a bit of a weed.
The choice we've got for everybody here is we could just add 10% FTSE 250 to our existing holdings, which would increase our risk a reasonable amount, or we can fund it with things. Now, we can fund it with the American market, but I'm with Mark in the sense that whilst the bond market is behaving itself, I find it's a struggle to see why the US is going to fall. We clearly got a lot of big numbers due this week.
What's the risk?
And there's a risk there without a shadow of a doubt. We could sell some of our Japan. I mean, Japan, if we look up there on our total return since inception, is a very strong equity return.
Our best equity market.
But I think we feel that we've only just started that ride with the new Mrs. Thatcher in charge. So it really comes down to, is there anything else we'd like to sell? Now, we could sell FTSE 100. There's no real point selling FTSE 100 because it's a pretty cheap index as well, and it looks pretty good.
And it's performed in line with the S&P.
And by the way, some of the ISA money, if that comes to pass,
feed in there.
will feed into
it will
the FTSE
feed in there as well.
100
Good point, extremely good point. So I mean, I'm to be honest, I'm with you. You know, the one that has really been disappointing has been the DAX.
Yeah.
I'm going to ignore the bear on my left. I mean, one day he's going to be right, and I'm going to look an absolute idiot. So,
as much
but
as
at the
me.
moment, just for this week, I'm going to ignore my friend on the left, and I'm going to suggest we buy 10% FTSE 250. We sell half of our DAX. That'll take us down to 5%, and then take the other 5% out of the gilt portfolio, and that's what I think we'll do for this week. We'll consider the oil. I like the oil view. I'm a little bit. I still think it's in a bit of a downtrend. I'd like to see more confirmation it's going in the uptrend, but there's a lot of upside to be had if it's right. So I think we should keep that one on the back burner to look at.
Yeah, and it's just rallied 8% in the last few days.
Already,
so it's difficult to sort of jump
Slightly
on that
unlucky on the timing there, Spice.
A few days. We talked about it a few days ago. C'est la vie.
So we've decided what we want to do on the portfolio, but how do we express it? Mark?
So you could buy an investment trust, but the trouble with investment trusts, they cost you quite a lot of money, and they normally sit at a discount to the actual value of the assets you're investing in. So I don't think that's a very good way of doing it. So we're going towards exchange-traded funds, which we've talked about before. These are very low-cost vehicles from which to do it. So there's one called the Vanguard FTSE 250 ETF, which I'm recommending we go into. It is about £2.2 billion in size against a FTSE 250 market that in total is about 400 billion, as we talked about before. And it only charges you 0.1% as a management fee. So it's really cheap. It does the job. It tracks what we want.
Good idea. Okay, let's do that. So we can buy the Vanguard FTSE 250 ETF. at which we can represent our views. We'll put 10% in there. And, let's hope she has indeed seen the light as we have been talking about.
Yeah, hands off our investments. I really hope that she doesn't go and change pensions or dividend tax or capital gains. Excellent. That is us for the week then. If you want to ask any questions to the experts here, these celebrity traders, they are taking your emails. Gentlemen, where do our viewers send their emails to?
The art of investing at IG.com.
I think it was better with our colleague here last week. Thank you very much for joining us. We'll be back the same time next week. Best of luck.
And we are back. What a Fed day it has been, gentlemen. I'm Ilya Spivak here in San Francisco. That's Dylan Radigan in Milan. Our returning champion, Mr. Mike Butler in Chicago. Gentlemen, it's been Fed day. I know I've been nerding out on everything Jay Powell had to say. How's it shaking out for you?
Well, from a Fed currency move standpoint, it's looking pretty good. At 11:30, I had Glenn on today from the tastylive team, and we were talking about yes, love him. We're talking about positions that
he was on this very show yesterday.
Hey, there you have it. He's everywhere. He's everywhere these days. Mm-hmm. But yeah, I put on this long dollar short franc position. It's up 25 cents, which is actually a big move because this is a really small trade. And then I was short the euro pound, which is also up today. But both of these positions, you're on the right side of the yield. So I'm short the euro pound, so I'm getting paid to hold that position with a positive swap bid. And then I'm long the dollar franc, which is on the positive side of the swap ask. So if I just hold this position into perpetuity, I'm getting paid every day to hold it. But if you zoom out here, this is where we're at in the dollar franc, all the way down here, seeing this big pop in the dollar today relative to the franc. So plenty of room to run if you wanted to hold it. And then, as from a non-dollar pair standpoint, we were just looking at other stuff.
You're practically a carry trader, Mike.
Yeah.
This is incredible.
Yeah. Well, it's funny because I was talking to Glenn. I'm like, this is the easiest thing I've ever done, this Tasty FX stuff. And he's like, what do you mean? I'm like, well, you just buy it or short it, and then you just forget. And then you come back to it 3 weeks later. And if it's not a winner, you just hold it for another 3 weeks and then see what happens. But
so this is the stuff that carry trade nightmares are made of. Because when people get hopped up long, high yielding currencies, and by the way, I don't think you're in a bad place here with your dollar franc, but what often happens in deeply oh boy.
Oh yeah.
And we got Meta.
And Microsoft both down.
Oh, and Microsoft. So when you get things like this in the indexes, carry trades tend to unwind in similar fashion. So
what are the headlines here, though?
Got to be careful here. Let's take a look at these headlines. I mean, this is obviously huge. What's going on here? Let's see.
Well, what's the order? I mean, the line looks scary, but what's the scale on that thing?
So
we're down 60 points.
Yeah.
So what on like 5%?
Almost 10%.
Wow.
Yeah.
Yeah.
So
this is
expected move in meta
looks like a thing.
Expected move in meta was on the higher end. It was at 60 points ish, like 6, 7, 8%. Microsoft was a lot lower of an expected move. It was only about 30 points, and that's where we're at right now, down 20. But yeah, double down in Microsoft Meta. We've got Google up 288. Google Alphabet actually, I assume that they posted the first ever 100 billion revenue quarter. We can check and see what the numbers are.
I'm looking here. Google revenue was indeed 1.02 billion.
Here you go.
versus, or 1.02 trillion rather, sorry, 102 billion versus 99.9. This is funny. 99.9 expected. EPS of 2.87 versus 2.26. So okay,
Yeah.
Google beats.
I was wondering why the Nasdaq was still green with Meta selling off pretty aggressively and Microsoft selling off moderately. But yeah, Google to the upside about 20 points ish.
Yeah,
A little mixed bag here.
a little bit of a mixed bag here. I'm looking for the specifics here on some of these others. Let's see. See if we can get some details on these Microsoft earnings here, because that looks like the one that hurts. EPS $4.13, so they beat on the upside against $3.66 expected. Revenue is $77.7 billion against $64.5 expected. So pretty good beat. But yeah, nobody seems to like it.
Yeah, the biggest miss, Meta missed bad on earnings per share. They had a $6.67 expected EPS. They posted $1.
Wow.
And then revenue, they expected 49 billion. They posted 51. So
Microsoft even beat on cloud sales. 49.1 billion versus 48.6 expected. So, I mean, these Microsoft earnings are kind of an interesting conundrum here.
Yeah,
I mean, these are not bad numbers.
What's the problem? I mean, why the reaction is it? I mean,
that's what I'm trying to see here, because it doesn't look like what we have is really that terrible of a set of outcomes. For Meta, I mean, it's pretty dire. $1.05 versus $6.67 expected. Revenue beat though narrowly. 51 billion actually, 49.4 expected. So it's interesting. It's interesting. I mean, that one makes more sense.
Yeah. I mean, we've seen this before, though. We've seen a double beat and the market sells off. And I think this only happens with these Mag 7 stocks where the market knows they're going to beat or post a double beat, but it's not good enough. And the market sells off. Like, that's really, we've seen this before in Netflix. We've seen it before in Apple, Amazon. Like, it's just the market expects so much from these huge tech stocks that if there's a number in if there's a number in the market's collective head and they don't exceed it, even if it's a beat, it can be seen as a negative thing. Or maybe they pull back guidance a little bit. We'll have to see. Maybe they'll dig into the conference call more detail. But yeah, interesting, ominous results here. And none of these are.
But also not universal, because Google, in other words, you can't even make it a Mag 7 crisis. It's more, it sounds like the best explanation I've heard so far is that it's some version of an expectations crisis.
Yeah.
It certainly seems that way. I think,
because it sounds like the performance is pretty good, actually.
Yeah. I mean, I think if you look at Microsoft, like if you look at Meta, it's very easy to say, oh, well, that's a massive EPS miss. Okay, fine.
Yeah.
I understand what that is. And it's very easy to shrug that off and say, yeah, you know what? Obviously, this is a big miss. Okay, cool. One-off thing. This doesn't poison the well, as it were. This is one company having one issue. Okay, and it's idiosyncratic. But when you look at what Microsoft is doing here, I mean, their results, I haven't dug into them clearly. I'm just looking at the top-line numbers here on the fly. But those top-line numbers look pretty good. I mean, there's nothing terrible here that I can see at first glance. And is getting cooked. So it's clearly not just a one-off Meta thing that's only about Meta.
Yeah. Kind of a wild scenario we have here. It begs the question, what happens with Amazon and Apple tomorrow?
Yeah.
And you're seeing a little selling. You're seeing a little sympathy selling in Amazon, down 2 points after the close here, and in Apple we'll probably see the same thing, a little bit down, a couple of cents, a couple of shekels, nothing crazy. But Amazon
it's not really spilling over into broader risk sentiment yet, which is going to be the other interesting thing. Like Bitcoin isn't really collapsing, the dollar isn't running away, so. We'll see, but to your point, it's starting to spill a little.
Yeah. Ominous move, indeed.
And after the Fed did what they did.
Yeah. So what is your? So we were talking about today, looking at the CME FedWatch tool, as we always do. Staggering increase in probability.
As we do right about this time.
Yeah. Oh wow! So we've got movement. Okay, we got big movement. Okay, so a week ago, if we look at the December,
that's the one to look at.
Yep. So here we go. I can throw this on the screen here. So, oh, maybe not. All right, here we go. So this is what I'm looking at. So we had 1 week ago a 4% probability that we would stay at the current 25 basis point cut that was just announced.
Yeah.
Yesterday, that probability jumped from 4% to 9%. As of right now, today, this probability is now 34%. That we stay. Wait, is this reflective of today's? No.
All right. So the current rate, as it presents itself currently, is 400 to 4.25 or 425 basis points. The pricing as it now appears is we are still likelier to get a cut narrowly in December, but the likelihood has significantly declined. So now we're looking at a 65% chance that we're going to get this cut from 375 or down to the 375 to 400 range. And the likelihood that we stay has increased from basically non-existent to 34%.
There we go.
It's kind of a mess.
Yes. And this was like 16% at 11 a.m. before he took the stand. So,
It was barely perceptible.
Yeah. So things have changed a little bit. Shifting.
Yeah. Yes. Just when you thought, and I wrote about this and talked about it. I wrote about this for the blog and also talked about it on Macro Money yesterday. The two, of course, are the written and spoken version of the same idea. And it's this idea that we also discussed here on the show yesterday with Glenn, this idea that if everything is already priced for perfection as far as Fed policy is concerned, what is there to gain? Like, okay, Powell comes out, gives everybody the rate cut everybody thought. Cool. That's in the price. What's there to gain? Is there maybe nothing to gain from just realizing the expectations as they were, but everything to lose if you say even a little bit something off? And Powell didn't say something a little bit off. He came out here and made a statement. And it couldn't have been clearer cut. Like, he went out of his way to make it. He said in his opening remarks that December is not a foregone conclusion, quote, far from it. Then he said it again in the Q&A, And then he reiterated and said, I know I get up here every meeting and I say we're going to be data dependent. Every meeting is live. I am saying more than that here. Like, he really pressed the point that if you're assuming December is definitely a go, but for the usual disclaimers, you're assuming wrong.
Yeah. It's quite the sentiment shift that we've seen in like a day, literally.
I mean, he really tossed a grenade out there.
It looks like we got some fringe stonks as well. Chipotle looks like they are down a little bit. They had some movement. Snapped up, snapped down. We're basically flat from the close, down a little bit, but
their EPS was in line. They missed on revenue though, a little bit. Expectation was 3.02 billion. They delivered 3.0 on the nose, so it's a slight miss. EPS of 29 cents as expected. ServiceNow beat. Wolfspeed beat. KLA beat. What else we got here? eBay, they beat.
Oh, that's still a company.
It is. They beat EPS by 3 cents. They beat by about, it looks like 9 billion on revenue, but that was a small beat, only 3%. Starbucks missed.
Yeah.
They missed on EPS 52 cents versus 55 expected. Revenue was steady. They beat by a hair. Carvana missed by 25%, but let's face it, it was not exactly the biggest number. It's just a big swing because EPS was expected at $1.37 and came in at $1.03, so not exactly very telling. I mean, these are just big swings because the numbers are tiny.
Yeah. I traded a handful of these. So I had a Starbucks call diagonal spread that I've actually had on for a week. That should be good. It's up a little bit, but I'll get a ton of this value in the short option out tomorrow. So this should be a small winner if we stay here. Chipotle did a call diagonal spread here, 40.45. Stock's just been beaten up, and this is such a cheap shot. This one should also be okay, even though there's a non-movement here, just from the short option premium. And then I did these like micro calendar spreads. So at Google, bought the 9-day 290 strike, sold the 2-day 290. This should be a nice winner. This is only $1 that I bought this for, but if you look at the raw value of these options, $400 that I bought, reduced basis by $325 in the option expiring Friday. So this will probably be like a $150 winner if we stay right at 290. And then I did the same thing in Microsoft, bought the 9-day 550, sold the 2-day 550. That was a $200 debit. Microsoft down 20 points. So this will likely be, I would say, a $100 loser max, because this 9-day, like the net debit is $200, but the 9-day raw value is $1,000. So this 9-day option, even this 20-point sell-off here, is still going to hold on to plenty of value. So we'll see. And then Google, already talked about Google. And then I actually did one in the queues. So I encompassed this whole week's worth of earnings, because the NASDAQ QQQ ETF, if you look at the earnings from the Mag 7s reporting this week, it makes up like 50% of the top holdings. So if you do something in the NASDAQ with QQQ, you are ultimately encompassing all of the earnings reports reporting this week. And QQQ naturally has a lower implied volatility, so it makes participating a lot cheaper. So I bought the November 645 call, and I sold the 2-day, which encompasses today's earnings and tomorrow's earnings, 645 call. So just another small calendar spread there. But if we get a rally in the Qs from the other earnings and maybe a reversal from the ones that failed today, this could be a nice winner too. But it's just saying defined risk, small. I thought today was kind of an ominous day because when you have big tech stocks that are reporting earnings paired with a Fed decision with Fed speak, it just sets up for kind of a weird scenario. Do you agree?
I agree. I mean, I think there's a lot that could have gone sideways here, and the market was clearly very happy to go into it thinking all of it is going to work out. And that was kind of the thing. It's like, well, when everything is at record highs and nothing is going to go wrong, let's say that's right and everything is going to be fine. Well, there's no speculative juice to do anything with that information. It's like that. It's like Eddie Murphy. What have you done for me lately? But all the risk is on the other side. The slightest thing goes wrong, like this Powell speech, like the Meta earnings here, and all of a sudden it's, oh my God, everybody is tilted way to one side. And now you've got to scramble to readjust. So there was a whole, I would say, a three-headed monster of risk here. Obviously, the Fed, the earnings, and the Xi-Trump meeting. And it didn't seem like anything terrible came out of the Xi-Trump meeting. Didn't seem like anything got announced either. So, I mean, it's obviously already overnight in Busan where they're meeting. So it's unclear what's actually going on, but they're ostensibly sort of getting this thing going. The meeting seems to have kicked off. There's some video of it occurring. There was a trade deal that the U.S. inked with South Korea ahead of the APEC conference. That's nice. But the Trump thing doesn't, at least for the moment, seem to have done anything to disabuse the markets of the idea that both of these sides want to kind of walk back all of this animosity, at least at a kind of immediate level, and get back to a gentle boil rather than a rolling boil. And clearly on both the earnings front and the Fed front, the rug got pulled. So those assumptions were very clearly wrong.
Yeah. Crazy market here. Someone calling out in the YouTube chat, Fiserv. This one got destroyed today.
Yeah.
Down 44%. Big move. Big move.
Yeah, Fiserv got taken to the cleaners a little bit here.
What's on your radar, Dylan?
I mean, I think the dollar thing looks very interesting. I like the dollar rally. I'm kind of not quite sure what to do with all this equity news, but it's hard to see how a long dollar short gold doesn't look better today than it did yesterday.
Yeah. I mean, if you sort of pull yourself back from the news and just look at the way the price action is responding, if you take a look at the ES chart and you can look at a 15-minute chart, just real short term, you can see here that you had this range going into the Fed, this kind of overnight range. And it seemed to have a bottom, let's call it somewhere around 69.30, maybe something like that. And then the Fed comes out and you plow through that range clearly. Now you've rebounded to its underside ahead of the earnings. That makes sense. And as soon as the earnings come, you hit that wall right there. So at least 15-minute charts are fuzzy and crazy and jumpy, and I wouldn't read too much into it. But the way that this kind of illustrates where the market's kind of emotional state is, you get the sense that, oh no, that wasn't cool what the Fed did, and then the earnings were not good enough to bring you back, though you tried.
I mean,
And
but
so
it
you
seems
get
like
this-
you could easily sort of stack this up into a nice, solid, meaningful sell-off between between the rate cut expectations and whatever this is with these Mag 7 earnings, which are not good enough, obviously.
Yeah.
Those are two pillars of this entire situation, obviously.
Yeah, I mean, I think more so than the NASDAQ, which basically rebounded more ahead of these earnings. That makes sense. I mean, why would people lean into NASDAQ shorts just after the Fed before these numbers came out? Obviously, we're going to, I think, see some follow-through on this, at least in the early minutes of tomorrow's markets, to kind of let the cash equity volume sort of adjust to whatever this is. But just looking at the ES futures here on the short-term chart, you get the sense that you had a kind of range carved out before the event risk, and your net response here was you've leveled down.
Yeah.
And that's why I sort of went in. The moment Powell said the magic words, the moment he said, I know I come out here and say the same thing about every meeting is live every time, and I'm saying more than that now, I put on a bunch of SPY put verticals immediately. And
Long
so
put verticals.
We'll see. Long put verticals, yeah.
Bearish. Bearish put verticals.
Bearish, yes. Bearish. Not NASDAQ, because it was kind of weird and vol was still expensive and you couldn't get clean 2-to-1 risk reward. In SPY, you could, like straight direct. If you went 51 days out, you could get, and I'll give you the actual levels that I have here. I've got the December 19th, so 51-day options here from basically at the money, 684, down to 675. Not a huge move. You could get perfectly 2-to-1 risk reward. So basically risking $300 to make 600. And I did that as soon as Powell basically came out and said, just in case you didn't hear me, I need you to hear me.
Yeah, some of these stonks are...
Then he said, my name is my name, dropped the mic and walked off.
I'm just waiting for him to show up half in the bag, tie loose, and just being like, this is my last time you'll see me on this pedestal.
Yes.
Meta continuing to retreat here down to 685. We're looking at a 15-minute chart. Microsoft catching a bid, only down 10. That's going to create a big vol crush if you were a premium seller in Microsoft. One of those situations where you'll probably see premium contract on both sides, even though it's down 10 points, except for maybe the longer term options. Shorter term options will lose a ton of value on both sides. And then Google, the strongest of the bunch, selling off a little bit from the highs, but still well within the implied move here, only up 15 points, and the projection was over 20. So we'll see what the rest of the market brings. Don't we have another rate decision? Am I correct in that overnight?
We do. We've got the ECB that's due. We had the Bank of Canada earlier before the Fed. They cut rates as expected. Also, interestingly, going into this, the Australian dollar has had quite the ride. If you're a follower of all things FX, the Aussie has been on something of a roller coaster here. There was some inflation numbers out of Australia that came out hotter than expected overnight, 1.3% on the quarterly, 3.2% on the year-on-year. The expectation was for 3%, so stronger. Core inflation higher. And Aussie jumped on that, basically on the idea that the RBA is not going to be pacing Fed cuts or anything like it. And then, of course, the Fed came out, pulled the rug out, and the Aussie is back to basically where it started. It's essentially flat to slightly lower on the day. So all of its CPI gains got taken away. The Canadian dollar is another interesting one here. The rate cut, as expected, so down by another quarter of a percent to 2.25. Not really anything here in the guidance that seemed to dramatically jump out. We do see that headline inflation is hovering around 2%. Inflation isn't really running away on tariff conditions. They did talk about structural damage caused by the trade conflict as being consistent with an annualized 1.6 contraction in Q2 GDP. So obviously Canada is feeling the pain here, though they still expect GDP to expand by 1.2% this year, 1.1% next year. So it looks like maybe we got standstill from here. So they'll pause now. And if you look at the Canadian dollar, it's a similar story. So they get the cut, they give the guidance. It seems like it'll be a hold in December for them. The Canadian dollar rallies, and then the Fed comes out and it gives it all right back.
Yeah, this is the pair that I was short. I think I shorted it right around here, around 138.8. And then I threw on another micro lot here, and I threw another micro lot somewhere up here. So my basis was like right around here. And then we finally got the washout yesterday that got me into slight profitable territory. So I closed the whole thing. But yeah, these have been fun.
I'm slightly short the Canadian dollar through the futures at 71.91, so basically like right around here. And if you look at dollar CAD, it sort of makes sense because this is the former range resistance that exactly where you're pointing, acting as support. So I'm basically long against that, essentially looking for that top that we've breached to hold.
I like it. Dylan, are you more, you said Amazon last week was your tried and true.
Amazon is always my favorite right now of the Mag 7. And if anything, I'm more optimistic for Amazon now that there's a little bit of a mess.
Yeah.
Granted, Amazon has come back a bit. You can kind of see that, if anything, my opinion on Amazon has been validated by the past couple of weeks. But, my hope would actually be, because I didn't put a very big position on it, just did some put spreads sort of halfway up that, somewhere in the middle of that recent ascent. But if anything, I would be optimistic that maybe we get it gets kicked around a little bit on just in the backwash of this Microsoft Meta reaction, and you can actually get involved with it. But again, also they've got their own numbers coming out. My whole hypothesis on Amazon is that they have a massive sleeper inside of it that's ready for a gap higher. And obviously earnings is an opportunity. We saw it with Google, we've seen it with Apple, we've all seen all these names, Tesla, on and on and on and on. That this exists, right? That these companies, however big they may be, are capable of these mega gaps. And you can even see on that Amazon chart going back however many months that is, there's that one big gap up. But also if you go in front of it a little bit, you get the gap down. It goes both ways. It's a sharp blade. So, but yeah, I think Amazon is the most interesting of the bunch on a risk reward basis right now. Although that could change. I don't know what the Microsoft chart looks like right now, but I don't mind Microsoft. Granted, I haven't flipped through whatever came out in this earnings report that caused the stock to behave like this. But I don't mind the stock a little bit cheaper. And obviously I'm not alone, because you could see, whether after that initial sell-off, it's already brought back a third of its lost territory. So I don't think it's a bad thing to get Microsoft a little cheaper.
Yeah, I think you'll see. I think you'll see this in a lot of stocks where even if there's a bad earnings report, even Meta, like Meta's the worst of them, catching a little bit of a bid now. But Meta, if we just look at what this gap's going to look like, let's say it opens at 700. If we go to a year to date, we're going to be opening at the bottom of its range where it was trading at before it got to the point we're at now. So I think you could very well see us open at 700, and a couple weeks later you could see it bid all the way back up. I mean, this is just the nature of these massive tech companies that everyone wants to buy. To Dylan's point, especially when you get a big discount like this on an earnings report. I mean, they didn't have the best earnings, but I think when you look at these earnings reports and you see a double beat and the stock go down, I'm more inclined to buy that dip than something where there are issues that are being shown.
And they're like, "Ooh, the robots don't work after all."
Yeah. Uh-oh.
All this money we're spending, can't do it. Can't do it.
Never
anymore.
mind.
Yeah.
Never mind.
But yeah, I think Amazon and Apple, and I think what you'll see tomorrow in both of these, if we look at Amazon, 15-point implied move for this week on a $230 stock, that is just over, it's like, call it 6-7%. But when you compare it to the rest of the year, it's a huge chunk. 15 points relative to 23 through December, 28 through January. So I think you could see this implied volatility get bid up a little bit more, especially now that we've seen a little bit of two-sided action with the earnings that came out today. And then Apple, this one is really low implied volatility for the stock price, $270 stock price, 8-point implied move. That's super low.
Yeah.
So, but if you're buying options, if you're doing diagonal spreads or calendar spreads, Apple is interesting because it has virtually no implied volatility relative to this earnings report we're going to get. Amazon, a lot more implied volatility across all of these cycles. So it'll be more expensive. And these actually are similar price points. So if we just look at Amazon, what's the 240, what's the at the money option trading for? $1,100 in December for Amazon and $1,100 in Apple, but Apple is 40 points higher in price. So same option cost, but Apple's 40 points more expensive. That just speaks to the implied volatility boost that you're seeing in Amazon relative to Apple.
Which is interesting, right? Because Apple's had a pretty decent rebound here around that idea that there was that report I want to say about a week ago, maybe a week and a half, about relatively strong iPhone sales for the new models, and that there was some concern that maybe they wouldn't go. Maybe, I mean, there's been tons of concern around goods uptake in general, because of course, as we heard from Powell today, as we saw in the CPI report, goods inflation has significantly ticked up because of these tariffs, and spending has been kind of curtailed, especially at the higher kind of luxury end of things around that. But the report was, listen, this is fine. These things are selling. It's great. That marketing campaign with the crazy zoom distance, that clearly seems to be having some kind of an effect. I was certainly impressed. Somebody took a selfie from around where I live in San Francisco with the Golden Gate or the Bay Bridge kind of far, far, far behind him, and then took the photo and zoomed in, and you could see the Bay Bridge in granular detail, though on the zoomed out picture it was maybe a speck. So obviously impressive. So one wonders to what extent this is another one of those buy the rumor, sell the fact kind of things for Apple. I think it's a pretty good shot that they have solid numbers. But the question is, does the market already know that? Did we already shoot that shot?
Yeah. I think Apple's at the high of its range. Amazon's climbing back. So I'm more inclined to live and die with Amazon versus Apple. I think it's just hard. It's obviously harder to buy into the highs that is printing pre-earnings. Like this is a pre-earnings pump, as we call it. Amazon doing a similar thing, but not yet at highs that it's already been to. So we'll see. Looks like E-minis and NASDAQ catching a little bit of a bid here. Meta at 700.
It looks like it's steadying a little. This will be very interesting for how this is going to play out overnight and into the cash equity open.
Definitely. Yeah, Microsoft's only down 9 points now. It's reversed almost the entire sell-off. Love to see it.
That's the one you'd expect to
ridiculous when you think about it, especially because it's, again, the market, the amount of money represented by that amount of movement. You know, I'm seeing it's a statement of the obvious, but
yeah. Well,
I mean, it almost makes you wonder if somebody, it's like a fat finger, like if somebody just misread the number.
Yeah. Well, that's like this move here. This is the craziest move I've ever seen in my life for any earnings announcement. It was. The earnings were after the close on this day, gap down from 285 to 265, so 10% haircut. And then once the trading session opens, reverses the entire earnings move, gets back to basically where they closed, and then the next trading session just vaults higher. It's like, what is this? How do you sell off 10%? It's like literally a fat finger misread. It's like sell off 10% and then, oh, we read that wrong. Let's actually goose this thing up to be over 300. It's crazy. I've never seen anything like it.
What about short gold on the back of strong dollar, more disciplined Federal Reserve?
So I added into this position earlier.
Added into the short position or the long?
Added into the short position, and this time I was in the know on the 1 ounce futures, unlike the first time I did it where I didn't even know, and so I had to do it with GLD. This time, since the 1 ounce futures exist, and you can basically do with them as you would with a microcurrency contract like an M6E or an M6B. It's sort of a very comparable thing, especially M6E where the margins are a little bit higher. I just straight up sold one of these things on the bounce. If you look into a 4 hour chart here, you can kind of see the logic. So you get this break and then you get a bounce and backfill. And once we sort of started that bounce and backfill, I didn't, of course, get the absolute top of the bounce. I never do, and I don't think anybody consistently does. But once you sort of got that first green bar off the bottom and you started to grind against that area of friction there, I just sold one and basically said, okay, well, let's see. Because the Fed is not going to give the markets anything more dovish than they already think. All the risk is on the other side. As it turns out, that's exactly what's happened. So we'll see if it lasts. That's a whole other question. I mean, Xi and Trump could decide to throw water at each other and this thing could go off the rails. So we'll see.
A couple of squirt bottles.
Yeah. I mean, get these guys some super soakers, let them out into Busan, see what goes down, see who wins.
That'd be incredible. If that's how we solved international political issues with a couple of super soakers. But yeah,
for every direct hit to the face, you got to give up one thing on your list of demands. Like, oh, export controls, those are gone. Shoot better.
Better than killing each other's young men.
That's
right.
True. That is true. Much better.
If you must spike the super soaker with some lemon juice, fine, to make it interesting. Make it sting a little. Okay.
But it doesn't. But at least you're fighting with each other instead of using the children of poor people in Russia or the children of poor people in America to go murder each other.
Endlessly preferable, the super soaker solution. And we could make content out of it, which is what we do now.
It would be the biggest event of the. Imagine if it was, whatever. Who pick your two favorite world leaders, Putin and Trump?
You could sell Trump sneakers at this thing. It'd be great.
Super Soaker Showdown.
Sponsored by
Madison Square Garden.
Yeah.
Yeah.
Sponsored by Truth Social.
3 billion people watching.
Trump could even do it in the Trump shoes to show how superior they are.
Oh man, it would be the biggest marketing ploy in history.
I mean, 3 billion.
This is the president for it. Come on.
I hereby challenge you to a Super Soaker Showdown.
Let's do it.
In exchange for 20 years of rare earths mineral rights.
Yeah. Yeah.
Put it on the table.
Trump catches one, export controls on Huawei, goodbye. She catches one, okay, rare earths got to come over.
Incredible.
Let's figure this thing out.
I think the 15-minute chart actually is what I'm looking at now. Looks cleaner now that we've got some time under our belts here.
Yeah.
Yeah, Google's hovering around 288. Microsoft 530. Well inside the expected move downside, and then Meta still sub 700, but it caught a bid after getting as low as 680 ish. So yeah, we will see what happens on the open. We'll definitely get some overnight movement, and then we've got Apple, Amazon, and a handful of other earnings tomorrow. If we look at the earnings watch list and sort it by date, take a look here. Yeah, Apple, Amazon, Coinbase. That'll be a fun one. First Solar.
Yes.
CBOE tomorrow or Friday morning. But yeah, Apple, Amazon, Coinbase, those will be the three that I'm focused on tomorrow. For sure.
Yeah. I mean, Apple, Amazon, obviously. I mean, I think probably the biggest, kind of most interesting thing in my mind is, do you actually get any kind of a run in anything at all as you go into tomorrow's session, considering the market obviously knows that these things are coming after the bell? Because if you get some sort of follow through and the market doesn't essentially demand, like, okay, listen, you have to wait for these things. If there is not that, then that would be a pretty emphatic sort of point of conviction where the market would go, look, we've made up our mind. This is it. Whatever Apple and Amazon say, good for them, but sentiment has either turned or hasn't. So that'll be very interesting to watch, I think. How the cash equity day works out tomorrow and whether the market ultimately decides to either shrug this off or not, that'll be interesting. I think if I had to guess, I would say they don't make a decision. They wait. And that might actually be an interesting mulligan opportunity. If you thought that sentiment was likely to weaken from here, you probably get a bite at the apple tomorrow because the market's not going to want to make up its mind. Not yet.
Yeah. Just hit refresh on the FedWatch tool. We got another 4 percentage points of probability for December that we are at 37540. So 68%, almost one standard deviation. But yeah, a lot of uncertainty.
Not negligible.
Yeah. Uncertainty.
Not negligible.
Uncertainty across the board here.
Yeah. I mean, did Bitcoin just tip the hat again? Because Bitcoin was weak going into this and seemed kind of weak need, especially if you look at the shorter term charts. It was kind of starting to roll into these announcements. Did Bitcoin essentially hint again, as it has recently where sentiment was going to go, or is this just an incidental kind of a thing?
It's a good question because it's been down all day. And ultimately, there hasn't been much of a bid except for right around 130, which is interesting. 130, big sell-off, then you caught a bid and you closed above where we were right at 130. So, yeah, I mean, this thing is always going to be volatile. I think now, like if you're trying to buy into Bitcoin or if you're trying to layer into like Leaps and IBIT, like this is the time that I'm looking for to do that, where you have nobody talking about crypto, or very few people talking about crypto. You've got 50% IV, which is, I mean, a 47 IV rank doesn't necessarily tell the whole story because we've seen IV in here significantly higher. But yeah, it's having a hard time staying afloat. But that gives you opportunity. If you believe that Bitcoin will eventually be 200K, 300K down the road, these are the sell-offs you're looking for to layer in. And then you just need that euphoria week or month where everybody's buying in. It's all over the news. Like it's going to happen again. It's just a matter of why and when.
Yeah, I mean the real question is sort of how disconnected is this thing from broader narratives. It seems like basically, at least since the beginning of this year, let's not get ahead of ourselves, but at least since the beginning of this year, Bitcoin has been mainly just a reflection of risk sentiment.
Yeah.
And so it's looked basically like NASDAQ.
Mm-hmm. Yeah.
And if that's what it is, then it's less so a thing unto itself,
mm-hmm.
and more so just the NASDAQ on steroids.
Yeah.
Because it's not a currency hedge and it's not a store of value and it's not a technology. It's a speculative chip.
Yes, that's exactly it.
Well, we did have Ryan from the Tasty Crypto team on Monday, and we always walk through implied moves, Bitcoin dominance relative to Ethereum, Solana. We looked at correlation, and interestingly enough, the 2-week correlation was super strong to the S&P and NASDAQ over the last 2 weeks relative to where it has been over a 1 month, 3 month, year-long period. So we are, in the last 2 weeks, we have seen a much stronger correlation with the broader indices. If that tells you anything. But I mean, there will obviously be times where it decouples.
Sure.
And there will be times where everything's ripping and everything's selling off. But yeah, for the most part, if you look long term, it does have a positive correlation with the NASDAQ and E-minis, more closely related to the NASDAQ, just based on the nature of it. But yeah, it's absolutely
not surprising.
It's absolutely on steroids. To your point, I mean, it will have higher implied volatility than the NASDAQ. Period.
Yeah.
So yeah, if you're looking for a more, and that's really the question is like if you have a portfolio and you're dividing it up into pies, it makes sense to have exposure to Bitcoin solely because of the asymmetric risk opportunity and the implied volatility of the instrument. It doesn't mean you need to be like 70% Bitcoin unless you have laser beams for eyes. But yeah, it makes sense to have in your portfolio.
I wouldn't recommend it.
Yeah, it makes sense to have in the portfolio, even if you don't think it's really going to go anywhere. It's more about just sizing correctly to be like, okay, I'm not sure this is really going to take off, but if it does, I want to be in that for the ride because it's going to be great for the portfolio volatility in itself.
Yeah. Yeah.